the meeting to order. Welcome to meeting number 44 of the House of Commons Standing Committee on Finance, pursuant to Standing Order 1082 and the committee's motion adopted on Tuesday, April 27th. The committee is meeting to study the subject matter of Bill C-30, an act to implement certain provisions of the budget tabled in Parliament on April 19th, and other measures. Today's meeting is taking place in a hybrid format pursuant to the House Order of January 25th, and therefore members are attending in person in the room and remotely using the Zoom application. The proceedings will be made available via the House of Commons website, and so that you're aware, the system of the webcast only shows the person that is speaking rather than the entirety of the committee. And we ask that screenshots of the total committee and its witnesses not be taken. So with that, we will go to the agenda. We're looking to 10 different departments in this panel. With 23 witnesses, all on video. Mr. Xavier, I believe, is on voice. And we'll deal with part 4, divisions 10, 14, 17, 18, 19, 26, 27, 28, 31, 33, and 37. And rather than me getting into an introduction of all the witnesses, I'd ask when the spokesperson for each division comes forward, if they can introduce themselves, their department, their position, and any other colleagues they may have with them. So I do want to thank you all, the witnesses, for coming. And we will start with Division 10, which is the First Nations Fiscal Management Act. And I believe that Ms. Davidi, I believe, is the spokesperson to start off with. So we'll start with Division 10, First Nations Fiscal Management Act, and go to questions as we've done in the previous panels. Who's on? Is it Ms. Walsh or who? I see Ms. Walsh, you're on mute. If it's you that's coming forward. Who's handling Division 10?
It's myself. Thank you very much.
Okay, I see you there now. Go ahead.
Mr. Easter. I'll start with a brief overview. My name is Garima Davedi. I'm from Crown Indigenous Relations and Northern Affairs Canada. I'm the Director General of Indigenous Institutions and Governance Modernization. I'm joined today by my colleagues, Leanne Walsh and Jeffrey Clark, and I'm joining you from the unceded traditional territory of the Algonquin and Anishinaabe people. I'm pleased to be able to speak to you on the proposed amendment to the First Nations Fiscal Management Act, which, if enacted, would expand the types of revenues that First Nations can use to support borrowing from the First Nations Finance Authority. Since 2006, the First Nations Fiscal Management Act has enabled First Nations who voluntarily opt in to exercise jurisdiction over fiscal matters, such as financial management, property taxation, and local revenue generation. The Act also provides First Nations with access to long-term financing at preferred rates through the issuance of bonds on capital markets, allowing them to leverage their own sources of revenues to access capital for infrastructure and for socioeconomic development, and through which over $1.3 billion has been raised. The First Nations Fiscal Management Act is led by First Nations, with more than 300 First Nations across Canada benefiting from the fiscal services offered by the regime's 3 First Nations-led institutions: the First Nations Finance Authority, the First Nations Financial Management Board, and the First Nations Tax Commission. The amendment being proposed is one that the First Nations Fiscal Management Act institutions and their members have wanted for some time now. Currently, First Nations cannot use First Nations goods and services tax or the First Nations sales tax as a revenue source for pooled borrowing through the First Nations Finance Authority, because Section 67 of the Financial Administration Act prohibits the assignment of Crown debts. It had been considered that borrowing revenues from the First Nations Goods and Services Tax and the First Nations Sales Tax would likely constitute an assignment of Crown debt. The proposed amendment would remove this impediment. The wording of this new provision, including the subsection stating that it's not binding on the Crown, is consistent with similar provisions in other federal legislation that make exceptions to Section 67 of the Financial Administration Act. If this amendment is enacted, the related regulations, financing secured by other revenues regulations would also be amendments. The proposed change would remove the obstacle First Nations have had and enable them to use, should they choose, the First Nations Goods and Services Tax or the First Nations Sales Tax as a source of revenue to secure long-term financing through the First Nations Finance Authority. Thank you.
Thank you very much, Ms. DeVetti. Is there any questions from members? I have up Ms. Jensen. Go ahead.
Yes, thank you. I just have a few questions. How many nations have opted into the First Nations Fiscal Management Act?
Over 300 First Nations have opted into the Act, and that's voluntarily opted in.
And are you saying that this will allow them to borrow money based on GST that they're collecting? Is that what you're saying?
That's correct. What this would allow is they have GST that's collected on their behalf through the CRA and given back to them, as well as First Nation sales tax. And they would be able to use those revenues from the GST or the sales tax to borrow money through the First Nations Finance Authority for pooled borrowing. So it would be a source of revenue against which they could borrow. And they would borrow it for infrastructure and economic development purposes.
Okay.
Then next is Mr. McLeod, followed by Ms. Zurwitz. Michael? You're muted there yet, Michael.
Sorry about that. Thank you, Mr. Chair, and thank you for the presentation. I have a question on the First Nation Fiscal Management Act and the amendments and who it applies to. I represent Northwest Territories, and we have a different system in the north, and that's pretty much the same in Yukon and Nunavut. So these amendments, do they have any implications for the north, or is the north? I guess the question is the north part of it, or are they not part of it?
So these amendments are for First Nations who have opted into the First Nations Fiscal Management Act. At the same time, we are working on regulations under Section 141.1 of the First Nations Fiscal Management Act, which will expand eligibility for other it's actually Section 141, which will expand eligibility for other self-governing modern treaty First Nations to have access to the Act. And so through that mechanism, they too would be able to access pooled borrowing through the Act and would have access to FNGST and FNST as a means for using that revenue for pooled borrowing.
Okay, I have one more question. So that's good to hear. The modern treaty holders, self-governing nations are going to be included. I'm assuming it's going to be through the self-governing fiscal policy that is being negotiated, or the terms are being negotiated that will allow this. I'm a little bit curious to see how it's going to work in the north on Indigenous lands. The government of Northwest Territories collects all GST and everything else. So it's a different ballgame in the north. So I'm just wondering how that'll apply.
Thank you, Mr. McLeod. So what we're working on is actually regulations under the First Nations Fiscal Management Act, 141 regulations to expand eligibility to self-governing and modern treaty First Nations. I'll also turn it over to my colleague Leanne Walsh to see if she'd like to add anything further.
Thanks for that, Garima. There are First Nations in NWT already participating in the Act. Salt River, for instance, First Nation works quite well with the Finance Authority and has used those tools to help advance development in their community. So I just wanted to let you know that there are 15 self-governing First Nations who currently have agreements with the Department of Finance for the collection of FNGST, the First Nations Goods and Services Tax. So that is open to First Nations to negotiate, including self-governing First Nations, to negotiate with the Department of Finance. I don't know specifically the context of how it will work on the lands in settlement lands, but I believe that would be also included.
Thank you.
You okay with that, Michael?
Yeah, that's great. Right. Thank you.
Ms. Sirowitz.
Thank you so much, Mr. Chair, and thank you, Ms. Dvivedi, for your great presentation. You had already mentioned that the amendment would enable funds to be used for infrastructure and economic development purposes. Are you able to speak a little bit more about how this amendment would help with economic growth and creating jobs?
Thank you very much for your question. With this amendment, what it will allow is, for example, if a First Nation wanted to use the revenues from FNGST or the First Nation sales tax to build, let's say, a gas station or some other economic development type of activity, then they could build that using the revenues from FNGST, FNST, and they could get a loan through the First Nations Finance Authority through the capital markets at reduced rates in order to build that. So that would generate economic activity. That would be an example. I wonder if that helps.
That is very helpful. Thanks so much.
Okay, is there any other questions from members? Hearing none, we'll move on to the next division. Thank you both very much. Then we'll turn to Division 14, which is the Canada Community Building Fund. So who's up on this one? Just start and go ahead and introduce yourself and your colleagues with you.
Bonjour et merci beaucoup.
Hello, my name is Eric Malva, Director, Infrastructure for Governance and Reporting, and I'm accompanied by Nathalie Lachasseur, Director General for the Integrity of Programs. We'll give the presentation for Part 4, Division 14. The fund on government taxing is a permanent fund prescribed by the law and index that offers more than $2.2 billion per year to finance municipal infrastructure as well as First Nations infrastructure. And a bill was tabled to suggest a transfer of $2.1 billion, which is twice the amount that was committed to be transferred every year. And this bill also proposes to name the tax fund on gas to the Community Building Fund for Canada. I'm at your disposal to answer any questions.
We'll go to questions if there is any. I think people are reasonably familiar with this. It's changing the name of the gas tax fund, simply put, plus putting more money to it. Any questions from anyone? Great program for communities. None? All right. Thank you. Thank you very much. There may be questions before the end of the panel. You never know as people think about it there. Folks, Eric. Then we'll turn to Division 17, which is the Telecommunications Act. Who's up on that one? I see Mr. Arbor. I believe him shaking his head. You're away.
That's correct. Thank you, Mr. Chair. My name is Andre Arbor. I'm the Director General of Telecommunications and Internet Policy at Innovation Science and Economic Development Canada. I'm joined by my colleague, James Nicholson. I'm happy to speak about Division 17, which involve amendments to the Telecommunications Act. These amendments are about improving the coordination of broadband funding programs. The federal government has a number of programs that fund the expansion of broadband infrastructure in underserved areas. This includes, for instance, the Universal Broadband Fund delivered by ISED. But the CRTC, Canada's communications regulator, delivers a broadband fund as well. And that fund operates under the auspices of the Telecommunications Act. The CRTC fund is a bit different from normal grants and contributions programs. It's funded by a levy, and the CRTC is also different overall in that it's an arm's length tribunal that operates separately from typical line departments. The amendments today, there are two key amendments to facilitate the coordination of broadband funding. The first amendment involves appeals of CRTC decisions. CRTC telecommunications decisions have three avenues of appeal. An applicant can ask the CRTC to rehear a matter. They can file what's called a petition to the Governor and Council, or they can seek leave to appeal with the Federal Court of Appeal. These appeal avenues are intended or better oriented to deal with broad regulatory issues. The CRTC has a lot of regulatory business that is involved with regulating the telecommunications industry. However, when funding individual broadband projects, this could be a relatively small project, maybe a few $1,000,000 in a particular area, that project would still be subject to the same potential avenues of appeal, even though it's a much narrower issue. And therefore, there would be the risk that broadband funding would be tied up in appeal, and those projects wouldn't be able to roll out and help serve Canadians. The second set of amendments involve information sharing and would better facilitate the sharing of confidential information between the CRTC and federal departments, as well as provincial and territorial entities involved in supporting broadband projects. So with that, I'll stop and happy to take your questions. Thank you.
Thank you very much, Mr. Arbor. We will go. Ms. Jansen, you had your hand up, but it's still up. You're putting it down now, shaking your head. Any questions here for Mr. Arbor? Hearing none, you never know. We might come back to you, Mr. Arbor, before this session is over. Thank you very much for your presentation. Turning to Division 18 then, which is the Canada Small Business Financing Act. Who's on that? Canada Small Business Financing Act, Division 18. Do I see Ms. McRae?
Yes, sir. Thank you very much. We're pleased to be able to be speaking to the committee today about the Canada Small Business Financing Program. The Canada Small Business Financing Program is a statutory program, and it helps small businesses access financing. Under the program, the government shares the risk with financial institutions. In order to encourage lending, this would otherwise be available to small businesses or would only be made available under key favorable conditions. It was established in 1999 and it replaced the Small Business Loans Program. The amendments that are being proposed are designed to enhance the availability of financing to help small businesses by expanding the loan class eligibility to include lending for intangibles, including intellectual property, as well as startup assets and expenses. They're also designed to increase the maximum loan amount from $350,000 to $500,000. and to extend the loan coverage period from 10 to 15 years for equipment and leasehold improvements. They're also intended to expand borrower eligibility to include nonprofit and charitable social enterprises, to include the classes of businesses that are eligible to apply. And finally, to introduce a new line of credit product that will help with liquidity and to cover short-term working capital needs of businesses. It's important to note that this program is available across the country, and it's delivered, as I mentioned, with financial institutions. The adjudication of the loans rests with financial institutions, and it's their funds that are put forward in the loan. The government then pays out losses against the loans that in the amount of 85%. I'm happy to take questions.
Okay, and we have 3 questions on deck, 4. Mr. Kelly, Mr. St. Marie, Mr. Julian, and Mr. Fast. Starting with you, Pat, you're up.
Thanks. I've got a couple of questions here. First of all, I'd like perhaps just a quick explanation of how the budget allotment for this program works. This is a shared risk program, so the dollar figure in the budget that doesn't represent the portfolio of loans to be made. This is the loss provision, or is this like what exactly is the budgeted amount expended on?
Thank you. I'm going to turn to my colleague Steve Watton, who's the manager of the program, to explain the specifics in terms of the budget amount and then the amount of funds we believe have been estimated as that going back into the economy in terms of private sector lending as a result of these amendments. Steve?
Yes. Hi there. I'm the policy manager with the Small Business Financing Program. And basically, as a result of these proposals, we're expecting about $560 million of additional financing to small businesses across the country. The budget allocation is basically $36 million over the first 5 years. And then as things stabilize, because the loan portfolio can be upwards of 10 to 15 years, it'll be $32 million a year ongoing. That $32 million is associated with, as Francis pointed out, our share of what the net defaulted losses would be to the program. So when a loan goes into default, we cover 85% of the eligible losses, and the financial institution covers 15% of those eligible losses.
Okay.
And
so so when the minister would say that they're putting $500 million into a small business credit program, that what they really mean is that they're going to put $36 million into the loan loss provisions of sharing risk with banks who will actually lend the money.
Yeah, so this program is a loan guarantee program, and it facilitates access to financing, and it's the financial institution's money, yes.
Okay, I see the hands piling up, so I don't want to take too long. I do have another question or two here. So if short-term liquidity is a new criteria for this program, will a business that could not prove the reduction in revenue year over year and thus be excluded from the wage subsidy or the rent subsidy, but has nevertheless suffered catastrophically as a result of COVID? For example, a brand new business that new restaurant that's grand opening date was March 15th, 2020. Would they be eligible for a loan under this program?
They would certainly be eligible for a loan under this program.
Okay, yes. What other criteria would they face?
Basically, the financial institutions would do their due diligence about the feasibility of the the business, their ability to repay the loan. And basically they have to have annual revenues of less than $10 million, but there are not more conditions as a result of the line of credit facility versus the term loan sort of side of the program.
Okay, so the not demonstrating a loss is not a deal breaker, but they would still be subject to all the regular criteria that a lender would have, which would normally include profitability and revenue, which these businesses would not have.
Exactly. Yes.
Okay, so this isn't really going to help anybody that can't demonstrate those things. This isn't a relief measure or something that would likely help. Not a COVID relief measure.
Right. Sorry, if I could just add, it's not a COVID relief measure. It is a program that has been in place since, as I mentioned earlier, quite a very long time. And what we are doing now is modernizing the program. I would note, though, in terms of startups and businesses in their first year of operation, and I'll ask Steve Watton to confirm this, but my understanding is that between 2014 and 2019, which was the period of the last comprehensive review, which is public for this program, that approximately 60% of the loans were given to startups and to businesses in their first year of operation. Is that correct, Steve?
That's correct. Actually, it's between 60 and 65%. Yeah, depending on the year, but that's right.
Okay. Thank you. I'll leave that for my colleagues now.
Okay. Thanks, Pat. We'll go to Gabriel St. Marie next, and followed by Mr. Julian. Gabriel.
Merci.
Thank you. Very simply, it should be pointed out that in the large reference document, the question and answer part in the French version is presented in English. It would be very helpful to correct that. Thank you. Thank you. We do apologize for that inconvenience, and we will be in touch with our colleagues in government to replace that section. Thank you.
Thank you, Gabriel. Mr. Julian.
Thanks so much, our panelists, our public servants, for being here. We certainly hope continue to stay safe and healthy during this pandemic, and we appreciate your contributions to our country during this time. I'd like to zero in on the number of businesses that generally have accessed this financing over the last 5 years, and what the difference would be in expanding expanding the eligibility criteria. How many additional businesses would potentially be able to access this? And we're certainly talking about charitable organizations and social enterprise and community organizations. So I would be interested in knowing those figures that you have.
Sure. If I could take that, Francis.
Go ahead, Steve.
Just on the number and value of loans that this program has been facilitating over the last 5 years, we do in the order of about $1 billion of financing each year, and it's about 5,500, 6,000, 6,500 small businesses. It depends on the year. Some years a little bit higher, some years a little bit lower. The last couple of years has been $1.3 billion, and in and around the 6,000 small business sort of marker. So that's our benchmark. As a result of these changes, we're expecting about $560 million in additional financing, and that would help an additional approximately 2,900 small businesses. So it would be an increase of about 40 to 43% in lending.
Okay, but how many, when you look at social enterprise not-for-profits, how many additional businesses roughly would be eligible for the program?
Gotcha. So the not-for-profit and charitable social enterprises would be a small component of that additional 560 million. It's in the order of 40 to $50 million of additional financing expected each year, and that would equate to about 200 to 250 businesses, enterprises.
Okay, out of how many nationwide?
How many?
So we've got a stricter criteria before. Now we're broadening the criteria. Finance, I'm sure, would have looked at the number of businesses that are social enterprise, not-for-profit charities, or other types.
I don't have the exact number, but the general order would be there's 1 million small businesses in Canada. The not-for-profit charitable social enterprises are in and around the 6% figure, so that's probably around 60,000-ish. And what we're thinking is that of those not-for-profit charitable social enterprises, their take-up rate for looking for financing would be lower than what a for-profit business would be. That's why the number is a little lower.
Thank you. That's very helpful, both in terms of the number that are targeted. I mean, I have no doubt, and I'm sure all my colleagues on this call would agree that there are a wide range of charitable organizations and social enterprises that have really been hit hard by the pandemic. And so opening the criteria is definitely to the advantage of those. They're community businesses. They may not operate, there's not one owner taking all the money home, but they can make a huge difference in the economic life of a community.
Exactly. And I would just like to add to that, it would be a not-for-profit charitable enterprise. They would still have to have a business. It wouldn't just be a charitable organization or an association per se. It would still have to be a business.
Yes, absolutely. And my example, of course, is my background running the social enterprise that was providing equipment and supports to deaf and hard of hearing people across British Columbia. Nice. It is an operating social enterprise, but the access to capital and loans was problematic. So I know for a fact this is something that's a welcome initiative. I will say one thing, that the criteria has not changed with the federal government picking up 85% of any loan losses. What percentage of the loan losses go through Canada's major banks?
15%.
Sorry, no. I mean, of the 36 million, 32 million a year in loan losses, how many of those loans are with Canada's 6 big major banks?
Oh, what percentage would that be? I would imagine it's about 65 to 70% of that would go through the major chartered banks, probably about 20% to the Fédération Caisse Populaire, and maybe the rest through various credit unions across the country and smaller chartered banks.
Thank you. Thank you very much. Now, I have a comment, Mr. Chair, if you can permit it. $750 billion.
Make your comment.
$750 billion given in liquidity supports to Canada's big banks, and we're still underwriting their loan losses on this program. I find it perplexing, to say the least, that we're always showering on Canada's big banks money and supports when they should be carrying, after that $750 billion liquidity support package, they should be carrying a bigger proportion of these loan losses.
I'm surprised at that statement, Peter, but that's what I expected. Mr. Fast, you're on.
Oh, maybe some of us aren't surprised. I want to carry on the same line of questioning, but getting back to the whole notion of this being a shared risk program, as Mr. Kelly mentioned, did I hear correctly that the shared risk is 85%, 15%, and has been that way for many years?
So the shared risk is 85%. So essentially what a bank does is once they decide they're going to offer the loan, if they decide to use the program, they register the loan with the program. And then once they've done that, should there be losses on the loan, the bank needs to cover 85% of those losses and the government covers the 15%.
Okay, so 85% is covered by the bank? I thought it was the other way around.
Oh, no, sorry.
Yeah.
I thought it was the other way
around. Go
around.
ahead, Steve. Sorry.
Yeah, it's 85% is covered by the government.
Yeah, okay.
After the financial institutions realize on the securities and the assets that were financed and any personal guarantees.
Right.
So their net losses they submit to us, and then
that I understand.
We cover 85% of the eligible loss. Yeah.
Okay, my question was this: how long has that 85%, 15% ratio been in effect? Ever since the program came into existence?
Yes.
Okay.
Yeah. So the program came in existence in 1999, and it replaced the small business financing program, but certainly since 1999 and before that as well.
Okay. What's the default rate? Pre-COVID and during COVID?
Default rate, well, and I would make the distinction between a default rate and a loss rate. Default being the number of loans that default, and loss rate being the value of money. So the default rates are traditionally at about 11 to 13% in number, and on the loss rate is usually between 6 and 8% on the value overall, and that's you need to take into consideration too. There's also revenue streams that come in on this program as well. We have a 2% registration fee. We have a 1.25% registration fee. And over the last 5-year period, this program has been net positive from a cost recovery perspective, right? It hasn't been a drain on the fiscal framework per se. We're averaging, I think, over the last 5 years, probably about a 5 to 7, $10 million surplus each year. So that's basically the default rate and the loss rates.
Steve?
And COVID, sorry.
Yes, during COVID, has that loss rate remained the same, or has it increased?
It's remained the same to a large extent. We are on track as business as usual. That being said, we certainly realize and we're planning for higher than expected losses. One of the big recipients of this program, the beneficiaries, is in the accommodation, food, beverage services sector. And those guys, as you know, have been the hardest hit. So we're expecting quite a number of more claims to come in. But you can imagine, so when the loans go into default, the financial institution has to realize the assets, realize on the personal guarantees, and at that point in time submit a claim to us. We go through the claim and then process the payments stuff. So there's probably like a 6-12 month lag period between businesses going into default and us realizing and paying the claims, right? So right now at this point in time, we're flat, maybe a little tiny bit up, but we're expecting this year and next year, particularly as some of the government support programs decline, that those number and value of claims will increase.
Okay, thank you.
Thank you, Ed. Just before I go to Peter Julian, on the personal guarantees, given COVID, and you might not know the answer to this, Steve, have personal guarantees gone up? I mean, I hear from businesses who never had to, they're giving the personal guarantees now to the financial institutions that they didn't have to 2 years ago. It's a problem. When you have a personal guarantee, everything you own, it's a problem. Are you finding they're going up, or do you know?
I'm not 100% sure on the numbers, but I do know it's an optional personal guarantee that the financial institution can ask of the Small Business Bureau. It's not a mandatory requirement of the program. So I think it's an individual financial institution requirement and decision, and I think it depends on a case-by-case basis.
Yeah, I agree with you. It's optional, but one who has signed them many, many times, it's not optional if you want the money. It's that simple. You put your family, your house, everything at risk when you sign a personal guarantee. And for you as a business, I got to have the money. I'm going to do it. That's the situation in our heads on the business end. Peter Julian.
Thanks, Mr. Chair. I just came up again because of we hadn't talked about net of assets. in terms of loan loss. And so I'm quite stupefied by this. Did I hear correctly that 100% of assets in the case of a loan loss provision or guarantees go to the banks, and then whatever's left over is picked up 85% by the federal government?
So the way it works is, and I'll just take an example. So they register the loan with us. If the loan goes in default, they have to realize on all the assets, right, to minimize the loss and maximize the recoveries, right? And then they have to realize on the personal guarantees. So let's just take, for example, it was a $500,000 initial loan, goes into default right away. The bank would realize on the assets, bring that loss down to, perhaps 200,000, down to 300,000, and then they'd realize on the personal guarantees and bring it down again to, 200,000 or 100,000, and then that $100,000 loss, that loss net of assets and personal guarantees, would be submitted to the government. Then we would pay 85% of that.
So thank you for that. But the federal government actually provides the money in the first place.
No, it's the financial institution's money.
Okay.
We facilitate. It's a loan guarantee program, right? So it's their money.
Okay.
But and it's giving out dollars that would otherwise not be available in the absence of the program.
Okay, that's an important distinction. You're right. It would have been it would be pretty outrageous if it was federal government funding going to that same financial institution. So, generally speaking, you've given us a good example where 80% of the value of the loan in loan losses was actually picked up through personal guarantees and assets. Generally, do you have an average of what percentage of a loan loss is actually picked up through the guarantees and through assets?
I don't have that figure readily available, Peter. I do know the vast majority of these loans get paid down, and that the average claim sizes coming in are in the order of about $50,000 to $60,000, right, on the sort of the claims. And the loans are on average about $250,000 to $300,000. So it's probably about 1/6, right, either paid down through paying off or realizing on the assets and the personal guarantees. The remainder is about 1/6.
Okay, thank you. That's helpful. It's not a program I know a lot about, so that's helpful detail. Okay, thank you.
Can I go? I think you're on mute, Mr. Chair.
You can't hear me yelling at you, Tamara. Go ahead.
So I have just a clarification. So this is a program that is meant to encourage banks to help struggling small business. Is that correct? So there's a bit of more risk involved in these loans than there is in a regular small business loan.
That's exactly right. It's designed specifically to facilitate access to financing that would otherwise be unavailable from the financial institutions if they were a good prospect, et cetera. We would imagine that they would be financed through conventional sort of purposes. It's only when they get to the risk tolerance level, which is a little bit higher than what they would accept, would they tend to use this program.
And so what constitutes a riskier loan? Is that something that you have set the parameters of, or the bank has?
Well, the parameters wouldn't necessarily be established on that, but I will tell you that a riskier loan would be one where the small business is a startup, right? They don't have any collateral. They don't have any credit history. So with being a startup with very little money putting into the game, the banks have these credit scoring sort of models that they've assessed risk with, and it could be industry sectors. There's certain industry sectors that are a little more risky than others, the types of assets that are being financed could be a little riskier than others. So if you're financing real property, for example, that's a lot less riskier than if you're going to finance leasehold improvements in the accommodation, food, beverage, services sector.
So how do you make sure, if there's no actual parameters set, how do you make sure that those funds are actually used for the types of business that you're trying to encourage?
We request very specific documentation from financial institutions about where the money is going and for what purposes it is being used. So right now, the three asset classes are real property, equipment, and leasehold improvements. I mean, we're looking to expand those asset classes, but when they submit a claim for loss now on term loans, et cetera, we require specific documentation that supports proof of purchase, proof of payment for those asset classes.
Right, but I guess what I'm more concerned about is here's a fantastic program which is meant to ensure that small businesses that would not normally be able to access funding because they are riskier can get access to it. And yet we don't have, like, say, a risk level number that you would say, okay, that's the parameter under which this person would be, because it seems to me it would be very easy for not a very risky business to access funds in this program because a bank just wants to be a little bit more careful.
Possibly. However, it's a lot more administration for the financial institution to use this program than to use their conventional sort of purposes. That plus the fact that we charge a 2% registration fee upfront based on the value of a loan. So if you get a $1 million real property loan, there's a 2% registration fee sent in automatically. And on an annual basis, there's a 1.25% administration fee that we charge the financial institution. So it lowers their profitability. So it's only in the situations whereby it's riskier for them because it's more administratively burdensome. It takes longer for them to run a loan under our program than through conventional purposes, and it's a lot less profitable for them.
I was going to say, is there interest rate cap on a loan like that?
Yes, there is. So we have prime plus 3% on the variable loans, and it's the residential mortgage rate plus 3% on the fixed rate loans.
And
out of that prime plus 3%, 1.25% is paid to us. So their cut of this is only 1.75% over and above prime.
So the government is also taking a portion of the interest rate on these loans?
Yes. So of the prime plus 3%, we take 1.25%, and it's meant to be help offset the cost of claims.
And then just one more question. Well, it might become more than one, but during COVID, I know, a local restaurant here just was not. Many of them are not able to get the HAZCAP and all these different things because they're required to do things like they're locked down and they're supposed to give a projection of sales, which of course lockdown they can't. How many of these were able to come to you? Because I know HAZCAP, like I say, a lot of the tourism industry were not able to access those loans.
Yeah, so I would say the majority of them, to a large extent. I mean, last couple of years we've done like $1.3 billion in financing. This past year, given you have CBA, you have HAZCAP, you have BCAP and stuff, there are these other business support programs that have been out there. So we've dropped the number and value of supports that we're able to provide this year. I think primarily because of that, and primarily because of the risk environment as well. But we're still close to the $1 billion marker, right? We still did pretty close to $1 billion in financing over the past COVID year. So there was quite a bit.
Thank you.
Okay, thank you. We'll go to Mr. Falk and wrap it up with Mr. Kelly. Ted?
Okay, thank you, Mr. Chair. And thank you for all that information that you're providing. I do have a few questions. You indicated that there's an interest rate cap. You also said there was registration and administrative fees to the bank, which reduce their profitability. Mm-hmm. Is there a provision that the banks are not allowed to pass on those costs to the borrower?
There are provisions that they're not allowed to pass on to the borrower other than through the interest rate, right? So they're allowed to charge a prime plus 3%, and that's it. And then of which 1.25% of that prime plus 3 comes back to the program.
Okay. And are you typically finding that most lenders charge that prime plus 3?
It's pretty close, yeah. Prime plus 2.75 to prime plus 3, yeah.
Okay. Thank you.
Primarily because they're a riskier clientele as well. So.
Sure. Yeah, risk rated.
Yes.
Mr. Kelly, followed by Ms. Sirowitz.
Just you said that there's something about when you mentioned real property or loans that are for real property. That's, I guess, an old. That's not a new part of the criteria of this program. It's so purchases of real property have always been eligible under this program.
Yes, that's correct.
How much of this program on an annual funding basis is typically for purchase transactions of real property?
Yeah, so your first question, yeah. So the three primary asset classes under the program is real property, equipment, leasehold improvements. And your second question, the percentage, about 20% is to real property. 50% is to leasehold improvements, and about the 25 to 30% is to equipment sort of purchases. So on $1 billion, you'd have about 200 million ish going to real property financing.
Do you set out criteria separate from, say, that of the BDC or other regular commercial lenders for that matter on real property, on mortgages?
Only that if they're registering the real property under our program, then they have to take first rank security on that asset.
Okay. So I guess I'm asking about the actual credit criteria. So a small business gets declined for, so their bank will not give them the commercial mortgage they need to buy their premises. The BDC is already there as a Crown corporation involved in those kinds of lending transactions, and charging fees and interest rates that are higher than the bank so as not to compete with the bank for that business. The BDC turns you down. Is your program looking to meet that need there, or who comes to you for a commercial loan?
It would be a small business going into their financial institution. That would be an eligible business under this program. So if the financial institution would turn down that business in and of themselves, they have us as an option to register that loan under our program. And so real property lending, you can get loans for up to $1 million, right? And for equipment and leasehold improvements, currently it's 350, but as Francis mentioned, we're hoping to move that up to 500,000 just because of those amounts haven't changed over the last number of years. But in comparison to the BDC, the primary distinction there is that the BDC is the government small business bank, right? They do their own lending of their money and their advisory services and credit risk and assessing and all that stuff on their own. Whereas this program uses financial institutions as an intermediary and leverages the funds of those financial institutions and their risk expertise, if you will, to determine if they would give a loan to these small businesses under this program or not.
Okay, so the bank's lending criteria would be the same. They would follow their normal lending criteria. The fact that they have you as the guarantor doesn't alter their basic credit criteria. They would apply the same credit criteria, and then they just make the decision that we would only make this loan if we can guarantee it under your program.
Exactly. We have one of our conditions is basically that they have to do the same due diligence under the conventional lending as they do for loans under this program.
Right. Okay. Thank you.
Thank you all. Ms. Sirowitz, last question on this division.
Thank you so much, Mr. Chair. And I want to thank Mr. Watton for his patience and for answering all of our very detailed questions. My question relates to the intention of this program and these amendments as it relates to economic growth and creating jobs. Can you speak to that, please?
Yeah, so this program is designed to increase access to financing to small businesses that otherwise would not be able to get this sort of financing. And it's, a lot of these small businesses now are modernizing. We're in a bit of a digital economy, knowledge-based economy, and a lot of the assets and the financing, if you will, would be they're more softer sort of costs, like intangible assets, startup costs, inventories, marketing, promotion, websites, those sorts of things, which in the past, this program's been used for real property, equipment, leasehold improvements. So what we're trying to do is trying to modernize the program, make it more accessible for more small businesses to get access to the types of financing in the amounts that they require to start up, scale up, modernize. And as a result of these changes alone, the expectations are that we would facilitate an additional $560 million in the order of helping an additional 2,900 businesses over and above the 1 billion that we already do and 5,000, 6,000 small businesses. And as a result of that, you would get, additional employment, additional economic impact, et cetera, right? Additional positive benefits to society.
That is excellent, and that's excellent news. I think that Ms. McCrae wanted to come in, Mr. Chair.
Sure. Sorry.
Go ahead, Ms. McCrae. I missed you.
No, that's fine. Thank you so much. Really, I think Steve has really talked about the purpose of the changes. What we're here with today is proposed changes to make this program more accessible to more businesses of more types for more uses. And that's really what it is. And so the purpose is to expand availability of the program for really just more companies to be able to access it.
Thank you so much.
Okay, Tamara, did you want in on this still yet? Go ahead, Ms. Jensen.
Sorry, yeah, just one more question. So I understand this is trying to get more small businesses to be able to participate, but due to COVID and the programs that didn't work for many of those small businesses, most of your money previous year went to small businesses that were at risk and impacted by COVID. Did I understand that correct?
Not necessarily impacted by COVID. It would be just small businesses who are looking to get access to financing that the banks weren't willing to give them financing from conventional sort of purposes, conventional sort of products. So that may have been or may not have been COVID sort of related.
Okay, thank you.
Okay. Thank you all. Lots of questions on Division 18 on a lot of questions on that program. So thank you all. We'll turn to Division 19, which is the Customs Act and amendments to that act. Who's on this one? Go ahead and introduce yourself and your colleagues.
Thank you, Mr. Chairman, and good afternoon, honorable members of the committee. My name is Goran Dragovic. I'm the Director General of the CBSA Assessment and Revenue Management Portfolio with the Commercial and Trade Branch. Today, I'm joined by my colleague, Andrew Francis, our Deputy Chief Financial Officer and Director General with the Finance and Corporate Management Branch, as well as Yannick Mondi, the Director of Tariff and Trade Policy with the International Trade Policy Division of the Department of Finance. We're here today to discuss Customs Act amendments that are being pursued via the 2021 Budget Implementation Act, aimed at supporting modernized payment processes for commercial importers and ensuring fair and consistent valuation of imported goods by importers and minimizing the risk of foregone revenue to the Government of Canada. The agency is also pursuing changes in the 2020 Annual Regulatory Modernization Bill to authorize the electronic administration and enforcement of the Act. The combination of legislative changes being pursued via the ARMB and BIA will support the government's commitment to implement the CBSA Assessment and Revenue Management Initiative, or CARM, which will modernize accounting and payment processes for the benefit of importers, trade chain partners, and the government. The proposed changes to the Customs Act that are in the BIA will allow for harmonized payment due dates for importers, provide importers with the ability to make accounting corrections prior to a deadline without incurring potential penalties or interest, clarifying the obligations of person providing a deposit, bond, or other security to abide by the terms and conditions, and to ensure the fair and consistent valuation of imported goods. On the matter of harmonized payment due dates, the proposed amendments would establish authorities in the Customs Act to facilitate the establishment of a single harmonized payment due date with respect to commercial goods for various amounts owing during a period, rather than separate due dates strictly based on a fixed number of days after the importation. The intent of these provisions is to make it simpler for commercial importers to manage the payment of various amounts owing during a single billing period. On the issue of accounting corrections, the proposed amendments would allow for importers to make corrections before a deadline without triggering a redetermination that could generate penalties or interest. The intent is to encourage more accurate final accounting and to improve payment practices. Regarding terms and conditions for financial security, the proposed amendments would also clarify the obligations of persons providing a deposit, bond, or other form of security to allow for the release of goods prior to accounting, to abide by the terms and conditions that accompany that deposit, bond, or other security. These legislative amendments are necessary to allow the CBSA to pursue regulatory amendments relating to, among other things, electronic forms of financial security. And finally, on the matter of value for duty calculations, the proposed amendments allow for the definition of sold for export to Canada to be established in regulations in order to ensure fair and consistent valuation of imported goods. Establishing a definition of sold for export to Canada would ensure that imported goods are being valued in a fair and consistent manner, and it would address consequential undercollection of revenue. This closes a loophole and ensures that all importers are required to value their goods on the same basis, and will result in increased duty revenues of approximately $150 million per year. This amendment would also ensure that Canada continues to adhere to its international obligations relating to the valuation of goods, which require that the goods be valued based on the transaction value set by the last sale to a purchaser in the country of import. And that concludes my remarks for today, and I would be happy to take any of your questions.
Thank you very much, Mr. Vragovic. Any questions? I know there's quite a discussion on this the night of the evening briefings. Ms. Jensen.
Yes. Well, first of all, I think it's great to make it a little bit easier on the payment end of things, because I remember that was a real nightmare for myself back in the day. But can you better explain to me why we need to redefine or better define sold for export to Canada? Like, what is the spirit behind that?
Certainly. The valuation methods for sold for export to Canada are aimed to ensure that the value for duty of imported goods determined under the transaction value method is based on the sale that causes the goods to be exported to Canada. For example, today, a non-resident importer would declare the value of goods being exported to Canada based on the last purchase price of those goods prior to export, as opposed to the sale for export of those goods to a party related to a party in Canada for the purpose of import, creating a discrepancy between domestic importers and non-resident importers in the manner in which goods are being valued. So this creates a consistent valuation method, which is consistent with international treaty obligations.
You okay, Tamara?
No, sorry. I did not quite understand the explanation. Is there a way to maybe give me an example that I might better understand what you're trying to get at?
Sure. So a business that is registered as a non-resident importer for the purpose of importing goods to Canada is generally a foreign company located outside of the country or a subsidiary of a Canadian multinational. If they were to purchase goods in that country of export for the purposes of having those goods imported into Canada, the declared value is based on the last purchase price of the goods in the country of export, as opposed to the sale of the purchase price of the sale of the goods to the country of export being Canada, where the goods are being imported. So somebody could have purchased goods in a foreign country where the last sale price that they purchased those goods for would have been $100. But the sale price to the importer in Canada would be $150, but they're declaring the value of $100, which is the last price paid, as opposed to the price paid for sale to export to Canada. I'll perhaps also defer to my colleague with the Department of Finance, Yannick Mondi, if she could clarify whether or not I have that accurately, or perhaps put it into a simpler explanation.
Thank you. Can you hear me? Okay.
Yes, Yannick, we got you.
Great. Well, maybe providing an example. So for Canadian, for importers that have that are linked with a foreign party, they will have access normally to a price paid for the good well before it is exported to Canada, therefore being able to use a prior sale up in their supply chain. So for example, a US-based company that has affiliates in Canada that are the final purchasers will be able to purchase from, say, I'm giving an example, but purchase in China, pay a certain point, and declare that as the value for export, rather than the value of the Canadian importer that is importing that good, that final sale. So there can be, that's the example of where there's a discrepancy, because certain importers have knowledge of a prior price that is paid up in their supply chain in a prior transaction, rather than the final transaction that triggers, as Gordon was explaining, the actual export to Canada. So what we're trying to establish with this definition is that sold for export to a purchaser in Canada is under the treaty and under the Customs Act. What is the value that importers in Canada, purchasers in Canada, must use for the purpose of putting a value on goods imported to Canada. And that sets, of course, the value of custom duties and taxes to be paid. Because if you have basically knowledge of a price that you can use up in the supply chain, well, you will be, it will result in under collection of revenue, simply because the valuation for the purpose of custom duties and taxes then becomes lower as well.
Okay, so you're trying to capture freight costs and all that sort of thing from someone who is doing their own, no?
No, those would be also subject to the same rules. So price paid and payable is something slightly different. It doesn't play with the free on board element. It's really solely for the purpose of, I'm going to use a book as an example. So I'm a US, worldwide library. I decide to pay for China that book for $1. It's actually going to be sold at the end of the day. The last valuation, or not the last valuation, but the last price of export to a purchaser in Canada, which might be me, could be $10. But it's been bought for $1 by the US affiliate, and it's being shipped directly to Canada. So that's technically under the law right now, can be interpreted as a $1 value for the purpose of customs valuation. Meanwhile, the purchaser in Canada is actually paid $10 for that book, and I'm the purchaser, which means the valuation of the good should be based on that $10, not $1. I don't know if that helps clarify.
Yeah, I think a little bit better.
That's pretty good. Okay, with that, I see no further questions. Thank you both very much. And we will move on to the Part 4, Division 26, the Judges Act, an amendment to the Act. Who's on? Mr. Hoffman?
I'm here, Mr. Easter. Thank you. Good afternoon to members of the committee. I'm here with my colleagues, Mr. Patrick Xavier and Ms. Anna Decker. We're here to speak about Divisions 26 and 27. But just by way of brief introduction, on Division 26. The purposes of this amendment is to stop the pension accrual of a judge who is the subject of a report that's referred by the Canadian Judicial Council to the Minister of Justice. By way of background, this is being proposed because there has been a concern, a perception in the past that some judges who, and I should be clear on this, have a right to challenge these kinds of findings, have commenced litigation in order to ensure that their pensionable service continues to accrue. So what this proposed amendment would do, Mr. Chair and honorable members of the committee, would be to stop the accrual of that pensionable service on the day that a report is issued by the Canadian Judicial Council recommending their removal from office. So again, at its base, this is being proposed to continue to ensure public confidence in the judiciary. So I'll stop there, and please, if you have any questions, myself and my colleague Patrick Xavier would be happy to answer you. Thank you.
Thank you very much, Mr. Hoffman. I don't see any questions. That one's pretty straightforward in terms of, oh, we got Tamara on here, Ms. Jansen.
I'm just wondering, is this kind of the idea that many Canadians have been mentioning in regards to what's happening with the Attorney General? It's a sort of the same concept?
Sorry, Ms. Jansen, when you say the Attorney General, could you just clarify that for me a little bit?
Sorry, I'm just...
No, not at all, please.
Now all of a sudden I forget her name. Somebody help me. What's her name?
What province?
You're
thinking of Jody Wilson-Raybould?
Governor General.
Governor General. There you go.
General.
Sorry.
Okay.
Yeah. I'm new to the job.
No, this is to do with the judiciary. Go ahead, Mr. Hoffman.
No, I would just thank you, Mr. Easter, and thank you, Ms. Jansen. This is to do with the judiciary specifically.
Okay. All right. Then thank you for that. And I believe you're on the next one as well. Division 27, New Judicial Resources.
Thank you again, Mr. Chair. Yes, Division 27, as you said, concerns new judicial resources. So essentially in BIA this year, there have been a number of positions, 13 in total, that have been allocated to different jurisdictions across the country. The whole purpose of these amendments is as a result of a process, a standardized process that myself and my officials engage in with the differing jurisdictions. They submit business cases. We review those cases. We assess those cases. We assist the jurisdictions in building those cases, and then we provide advice to the minister, and the minister takes our advice and goes on to make recommendations. So essentially what these amendments do, and this is not a new thing, is they increase the complement of different courts across the country. So with that, I'll stop there. And again, we'd welcome any questions that you may have. Thank you.
Mr. Fast.
Yeah, thank you. Just so you know, I do support the changes to the Judges Act. In terms of new resources, there's 4 provinces, I believe, that are receiving additional resources, correct? Newfoundland, Ontario, British Columbia, and Saskatchewan. And you've mentioned that there's a business case that supports the recommendation. So this is not just a request coming, we want some more judges, and automatically they're sent or they're placed on the bench.
That's correct. There's some rigor to the process, Mr. Fast.
All right. With respect to Newfoundland, the appointment of additional resources was triggered by something called geographic structuring. Can you tell me what that was and why it would call for additional judges or a judge?
Thank you, Mr. Fast. I'm going to turn to my colleague, Ms. Decker, but I think you're aware that there was an Associate Chief Justice that was appointed to the Supreme Court of Newfoundland and Labrador, just to clarify that. But I'll ask Ms. Decker, who I must say has been an expert and has been involved in this process in the past, to try and meet your question. Thank you.
Ms. Decker.
Thank you, Mr. Chair. The Associate Chief Justice position for Newfoundland Labrador will assist the current Chief Justice to provide long-term efficient and effective administration to the court. Part of the decision to ask for one was the fact that Newfoundland Labrador does have such vast geography, and the way that they have organized their court, which is within the jurisdiction of the province gets to decide how to structure its courts and how to administer them. They have divided their child division into a family and a general division, and along 7 judicial centers. So that was simply one consideration that was taken into account as part of the request for judicial resources from that court.
Okay, so it wasn't just an action on the part of the provincial government to structure or restructure geographically. There are other elements that also contributed to the decision to add judicial resources.
Absolutely, that is one factor, but since every jurisdiction is different, we have to take into account the unique aspects of each one. In this case, or in the case of any Associate Chief Justice position, they help provide leadership to the court, and, for example, could allow the Chief Justice, if too much of their time has been spent simply administering and assigning cases and so on, this would allow the Chief Justice to have the opportunity to continue to hear cases and be a part of that important work of the court as well.
Okay, have we seen an increase in caseloads in Newfoundland?
I don't have that information. I don't have that information from me. That is something that the courts themselves and the courts administration support for the individual jurisdictions have. That is the kind of information that they would submit if they choose to make a request. But that information is not the federal government, so we would generally keep that entirely confidential, simply to respect the information that they provide.
Hold it. You're saying that they're keeping information about caseload levels in Newfoundland confidential because for some reason this isn't deemed to be in the public interest? Surely somebody has the caseload numbers, because I would assume that for the most part, requests for additional judicial resources are premised upon the fact there's additional need based on additional caseloads.
That's absolutely correct. And additional caseloads is certainly one of the important factors that we would look at, and we would ask the courts themselves to provide what individual courts and jurisdictions post publicly, and it could very well be that the Supreme Court of Newfoundland Labrador does have that information posted publicly, but it is not something that the federal government is able to collect directly.
Okay, do you believe it's reasonable for us as parliamentarians who have to approve this spending to ask for that information?
The information that has been gathered as part of the business cases is held in confidence, and that is in part because a lot of it has to do with it goes to the judicial function, which we would strive to protect for reasons of judicial independence. So there's no standardized or formulaic way of going about adding resources to any courts. It could be, for example, due to how the courts are administered by the provinces or by the territorial governments, for example. So demographic and geographic and social conditions also vary across each one. So one of the things that I can say that our group has generally looked at is if the case inventory has been steadily rising, for example, this could indicate that the judicial complement may not be sufficient. So that, generally speaking, is a factor we would look at. But again, that information is held by the courts themselves, not by us.
Listen, I'm not standing in the way of giving these judicial resources, but I think I'm asking a reasonable question that if in fact taxpayers are being asked to support additional judicial resources, I think we as their representatives who actually approve this spending through appropriation bills, etc., have some right to the information upon which these requests are premised. So could I ask you just to ask for that information and make it available to our committee, if at all possible? I say that through the chair.
Sure. You can respond to that, Ms. Decker, once you check with your sources to see what information is made available to us, and drop a note to the clerk. What's possible and what's not. Ms. Jansen and then Mr. Kelly.
Yes, I'm just wondering, are there any efficiencies, any parameters that are set that anybody's in the different provinces will need to achieve in order to be able to have these new resources? Like, do they just ask for them and they don't have to show any improvement in efficiencies?
It's a bit of an art in some ways, simply because the Constitution gives responsibility for the administration of justice to the provinces. So how the provinces have sorted out their procedures and how they use their judicial resources does vary a little bit across the country. So relevant information would be trends in filing cases in various areas such as family or civil or criminal, or we would look at patterns of case flows. But again, because each province or territory has such different demographics and different geographic and social conditions, it's not possible to give, this is what you must achieve in order to be allocated a new judicial resource. That's simply not the way the Constitution has set up the administration of justice in Canada.
So basically, if a province wanted to improve, they could ask you for numerous new resources and you would just have to provide it. Is that how that works? If they wanted to improve their wait list, they could just ask you for extras, and they wouldn't have to justify it necessarily.
There still is a very rigorous process that goes on, and that would be, for example, if there had been no efficiencies and they were simply not sitting, that would be obviously something that our information would show, and we would seriously question it. And the justification is something that we would develop in collaboration with the provincial or court officials whom we work with. And we do try to respect, for example, if a province has said that they want these sorts of matters to be heard within these sorts of timelines, that is something that we do try to work with. But at the end of the day, there is, as you say, a certain reasonableness that we would try to look for.
Okay, Mr. Kelly, last question on this division.
Yeah, sorry to maybe belabor it a little bit, but I did just want to speak in support of the issue that Mr. Fast raised, and that I understand that judicial budgets and appointments are not the same as other budgetary requests or items that we vote on, but no parliamentarian and no citizen wants their elected representatives to be told that the information that was that a funding request was based on is something we can't see or can't receive. We do have an obligation to ask these questions and receive information, not to merely approve everything that is put in front of us. So I certainly support Mr. Fast in his question to receive the information.
Okay, that is noted. Any further questions? Then thank you, Ms. Decker and Mr. Hoffman. Thank you for the presentation, and we will go on to, and we're going to soon start to run out of time on this panel, Division 28, the National Research Council Act, changes to that act. Mr. Scott, are you up?
Yes, Mr. Chair. Good afternoon. My name is Stephen Scott. I work as the Director General of Policy, Strategy and Performance here at the National Research Council. And I'm joined by my colleague, Christine Jodoin, Director General of the Biologics Manufacturing Center Project. The NRC legislative amendments are about positioning the NRC to deliver domestic vaccine manufacturing capacity in Canada going forward. There are two proposed amendments to the National Research Council Act. First, there is a proposed amendment to enable the National Research Council to manufacture and produce medical products, such as vaccines, on a larger scale to respond to pandemics and other public health needs. Currently, the NRC is authorized to produce medical products on a smaller scale for things like clinical trials and experiments. This new authority would provide the NRC with the ability to manufacture vaccines at a larger scale once the new Biologics Manufacturing Centre at the Royal Mount campus in Montreal receives regulatory approval by Health Canada. Second, there is a proposed amendment to provide the NRC with the ability to incorporate and stand up arm's length entities, such as not-for-profit organizations. Under this amendment, the NRC would be able to establish special purpose collaboration models that increase and deepen linkages between NRC researchers, academics, and the private sector. The new biomanufacturing facility, which will be operated through a public-private partnership over the longer term, is an example of where a new collaboration model could be used. Thank you, and we would be happy to take any questions.
Is muted. We'll go first to Mr. Julian, followed by Mr. Fast.
Okay, thank you very much for your presentation. First question is, what is the limitation of scale right now that the National Research Council is limited to?
Thank you for the question, Mr. Chair. The current legislative authority in the NRC Act provides the NRC the authority to manufacture at a smaller scale. So for clinical trials and experiments, it's not specifically defined in terms of quantity. It's a general authority related to scientific and industrial research. So there's not a specific quantity established to that current authority. The Biologics Manufacturing Center, oh, sorry, go ahead.
Yeah, sorry, just quickly on that then. If there is no limitation, what would stop the NRC right now from manufacturing vaccines?
Thank you for the question, Mr. Chair. There is a small legal interpretation that suggests that the authority that currently exists should be expanded to cover the Biologics Manufacturing Center production capacity, which once operational will be up to 2 million vaccine doses per month. So the interpretation is that even though there's not a specific quantity threshold tied to the current authority, the 2 million doses per month is sufficiently large that would be above a typical threshold for clinical trials, for example.
And is that subject to a legal, I mean, we're 15 months into a pandemic, so this is a very, I think, an appropriate question that the NRC now has the ability to produce vaccines legally. Was there a legal interpretation that suggested that the NRC could not be manufacturing vaccines beyond a certain level? And if so, what was the level that was set?
Thank you for the question, Mr. Chair. The legal advice from our Department of Justice colleagues has been that the way the National Research Council Act wording is interpreted is that it provides the NRC with the authority today to produce medical products on a smaller scale. So as noted, again, things for like clinical trials. So the advice was then to broaden that authority through the Budget Implementation Act, which would align with the project timelines for the Biologics Manufacturing Center that is currently being constructed.
Okay, thank you. But I'm still left a little confused. The NRC has had the ability all along to produce vaccines. Obviously, it was all hands on deck. And so the NRC would have been consulted and you sought a legal opinion. But what was the threshold? Is it 500,000 vaccines a month? Is it 1 million vaccines a month? Is it 100,000? I mean, at some point, given the NRC's capability, there must have been a definition or a response that meant that the NRC wasn't actively involved in vaccine production. And of course, as we know, we're trailing badly behind the United States. They're close to 40% fully vaccinated. In Canada, it's just over 3% fully vaccinated, and we've moved to a a model that is putting one shot in, despite the fact that manufacturers have expressed concerns about that because of the supply problem, because of the supply shortage. So I'm interested in knowing whether there was ever a precise definition coming back from Justice saying NRC, you can't produce beyond 500,000 a month, or you can't produce beyond 100,000 a month. And as a result of that, the NRC wasn't part of the solution.
Thank you for the question, Mr. Chair. I'll just offer 1 or 2 points and then turn to my colleague Christine to expand. So to answer the question, there was not a specific quantity identified as part of the legal opinion. It's more of a qualitative interpretation of the current legislative text in the National Research Council Act. And then I guess the second point I would say is the reason it's coming forward now through the Budget Implementation Act and not earlier or not sooner is because it's tied to the timelines with the broader BMC project that's being currently constructed at the NRC's Royal Mount campus in Montreal. At this point, I'll just defer to Christine, if that's okay, Mr. Chair, just to see if she has anything to add.
No, go ahead, okay. Christine.
Thank you very much, Mr. Chair. Maybe on a practical basis, to give an example of the interpretation, is that under this current authority, NRC is able to do R&D and experimental nature production. And so right now, for example, our Human Health Therapeutics Research Center can do production at the 20 liter, 50 liter, 500 liter bioreactor capacity basis. And that can be up to, depending again on the material in question, could be about 250,000 doses a month, for example. And so this is in this current authority. With the Biologics Manufacturing Center, the capacity that we are building and designing is to be able to produce with the capacity of a 500 liter bioreactor and a 2,000 liter bioreactor. So total bioreactor capacity of 2,500 liters. And so as Stephen said, this is the equivalent of approximately 4,000 liters of production capacity a month, and the equivalent of 2 million doses a month, with the caveat, of course, that it depends on the vaccine type and the manufacturing yield. But just to give you the comparative notion that this is a larger scale manufacturing, and that's why we're proceeding to ensure certainty that we can manufacture that scale with the Biologics Manufacturing Center.
Thank you. Sorry, I've got one more question.
Okay, just to interrupt for a sec, Peter. We'll have to try and the next 3 questions or 4, if we can be fairly brief. We are going to have to cut this panel fairly shortly because we do have another bunch of witnesses in the wings for the next panel, and we'll have to ask the last 3 divisions to come another day on this one. Go ahead, Peter.
The public-private partnership. So the NRC would be, through this legislation, able to vastly expand, as you mentioned, a bioreactor, 2,000 liters, vast expansion of vaccine production. But it also basically gives a portion of the NRC to the private sector, that the private sector, as part of this new entity, would be able to profit from the NRC's work. Is that, am I understanding this correctly?
Stephen, would you like me to answer the question?
Yes, go ahead, Christine. Thank you.
Okay, thanks. So we're currently right now assessing the model in terms of the future operation and governance of the facility. And so what the end game is the mandate of the center is public good, and to meet pandemic emergencies and always be ready for that. So with the public good perspective in mind, we are looking at different models. There are certainly for-profit, but they're also not-for-profit. And so as part of looking at the assessment, we have done preliminary consultations in the fall. And so the public good was strongly identified there, and not to compete with the private sector. So it gives us an indication of some models we need to consider. We are also set up a project advisory board that's made up of members of the biomanufacturing sector, big industry, small SMEs, academia. And so we're getting their input as well on the model. And we will also be doing expression of interest later this summer to really understand from the sector what they think would be a workable model in terms of making sure we can deliver on the public good mandate of the facility and make sure it is also sustainable into the future. Thank you.
Okay, Mr. Fast, followed by Ms. Jensen, and then we'll have closed off.
Okay, Ms. Jodoin, you just used the term public good. I assume that equates with the national interest?
Correct.
Okay, thank you for clarifying that. I just wanted to say to both of you, Mr. Scott and Ms. Jodoin, thank you for not precluding the involvement of the private sector to deliver vaccines, because partnerships are often the best way of delivering for Canadians. And I'm not surprised Mr. Julian has a different take on that, but I'm a strong believer in public-private partnerships. My question is this: would the amendments you're making today in any way prevent a company like Providence from leaving Canada and being able to actually put down roots in Canada by finding a partner within government that's going to support their efforts to deliver a solution to the vaccine shortages we have?
So I can answer that question soon if you'd like. First of all, what the center is being designed and set up with a cell-based biologics vaccine platform. So one that we really, when we're going to look at collaborating with vaccine sponsors, that's sort of the basis in terms of making sure that their vaccine platform is aligned with a vaccine platform that is being built for the center. That's one point. With respect to Providence, I think what I would say is I would have to defer to our colleagues at Innovation, Science and Economic Development. They are developing the biomanufacturing strategy. And so we're one part of this strategy. We're going to be here to collaborate with vaccine sponsors that can help us in being ready for any pandemic emergency to produce cell-based biologics vaccines.
Okay, so you've chosen cell-based biologics as the platform that if you were going to do a public-private partnership, the partner that comes in would have to be participating in a similar type of model, correct?
Just to clarify, the vaccine sponsor who we would contract with and produce a vaccine would need to have that vaccine, that platform. Yes. But in terms of partners, you know, when you look at partners, it can be to help govern the facility itself and to operate it, even with not having that experience in being the vaccine sponsor of the cell biologics. It's about your experience in operating a facility of this nature, operating it and governing it.
Thank you, Mr. Chair.
Okay, Ms. Jensen, last question.
Yes, I'm just wondering, I understand that basically what you're doing now is you're actually changing your, if you want to call it, mission statement from being one of a public institution to one where you're going to be actually competing with the private sector. And at the same time, you also got $126 million to build your production facility, which, I mean, when you see someone like Providence not getting anything but the runaround and now leaving Canada, I'm concerned that the way that these amendments are written, you aren't actually obligated to even work with private sector, but yet you're being handed a lot of this money, and now you're going to be competing with the private sector. I wonder if you could maybe speak to that.
Whoever wants to take that, some of that relates to decisions of ministers, which we don't expect either of you to answer. But as it relates to this division, go ahead.
Stephen, I can answer.
Go ahead, Christine.
Okay. So just to clarify, the mandate, as I said before, it is the BMC, the biologics manufacturers, that will have a public good mandate. So it's not intended to compete with the private sector, but to actually complement them. and complement them in such a fashion that we'll be ready to manufacture and provide the capacity to manufacture in response to public health need when the domestic market is unable to meet it. So that's one thing. And secondly, the key thing will be that the costs are cost recoverable. So what that means is that while the government is giving us funds to build the facility, in terms of the production, we will make sure that as it is producing, the cost to produce will be recovered.
So does that mean then you are only going to be producing when private sector is not able to manage the so you have this huge facility, it's there, but it will only be utilized for manufacturing when the private sector is not able to meet demands?
No, that is right. When there is a pandemic emergency, we're a gap filler in terms of making sure that there is production capacity if it's required for cell-based biologics. But separate for that, when in non-pandemic periods, we will be focusing on pandemic preparedness, but we'll also be focusing on other production biologics such as infectious diseases, such as orphan drugs for rare diseases as well. And we will collaborate with the private sector with that, because the key thing, that's one element in terms of the mandate, is that this is an example of how we will help to increase the capacity, the biometric capacity of the private sector by doing that. So in such cases, for example, we will work with SMEs who in some instances today have limited access to be able to scale up in a facility of this nature. So that's an example of where we will bring them in to support on the capacity. So what I want to confirm is that in every respect of the mandate, we will always be collaborating with the biomanufacturing sector. But the key priority will be that we will have our facility on a constant readiness state to be able to pivot to respond to pandemic emergencies in collaboration with the private sector and academia.
Okay, so I just want to make sure I'm hearing you correctly. You're saying that in general, when it's non-pandemic, non-emergency, you're going to be doing research. But then when it's pandemic or something along those lines, then you pivot to production.
Thank you. I want to clarify one thing. We're not actually doing research. The facility is focused on production. So what we're going to be doing is helping to put to market drugs that the private sector right now can't do on their own, either because it's high risk of failure, or because there is a lack of profitability. So that was the example I brought in terms of orphan drugs for rare diseases.
Okay, then thank you both for your presentation and responding to our questions. With that, we will have to suspend to the next panel. So for those that are here representing Part 4, Divisions 31, 33, and 37, we will have to find another time to schedule you back.
Point of order.
Yeah, go ahead, Pat.
Do you want to try and get through that? I mean, we've made up time in some of our other panels. Do you want to, rather than bring them back?
Just where are we at, Mr. Clerk, with the next panel? Are they all in yet?
Yes, they're all in the waiting room, sir.
Okay. Well, let's give it a try. We'll go 5 more minutes or so, see if we can get through these 3 divisions. Division 31, the First Nations elections. Somebody want to give us that presentation? We'll see if we can go through these quickly. If we can't, we'll have to suspend and go to the next panel. Division 31.
Thank you very much, Mr. Chair. I will go as fast as I can. I'm coming to you from unceded Algonquin territory. My name is Christopher Duchesne. I'm the Director General of Economic Policy Development at Indigenous Services, and I'm here with Yves Denoncourt, the Director of Governance Operation, and Carl Jacques, our Senior Legal Counsel. We welcome this opportunity to explain the measure of retroactivity to validate the First Nation elections and cancellation and postponement regulations. In March 2020, early in the pandemic, many band councils governed under the Indian Act and under the First Nation Election Act were faced with a dilemma: hold elections in their community during the pandemic, despite strong advice from public health experts to avoid gatherings and social interactions that could contribute to the spread of COVID-19, or wait for their terms to expire and leave their communities without leadership and creating a governance gap. Neither the Indian Act nor the First Nation Election Act provide chief and council with ability to extend their terms. So in response, to First Nation public health concerns surrounding the pandemic, the governing in council, on advice of the Minister of Indigenous Services, made the First Nation election cancellation and postponement regulations. The regulations allow First Nation chiefs and council, including leaders from bands holding elections under custom code, to extend their term of office of the chief and of the elected council for up to 6 months, with a potential second extension up to 6 months. The decision to post the election is under the purview of chief and councillors and must be made by a band council resolution submitted to the Minister of Indigenous Services. The regulations were enacted with a sunset clause of April 8th, 2021. On April 1st, 2021, the federal court found that Section 4 of the regulations, specifically enabling chief and council of bands holding their elections under custom code to extend their elections, is ultra-virus and invalid. The Government of Canada is appealing the court decision as of April 6, 2021. The regulations have been extended for a period of 6 months with a sunset clause now of April 8, 2021. Division 31 seeks to retroactively validate these regulations to ensure that decisions that were made pursuant to these regulations are valid and that no concern related to the power and the authority of chief and council during that time comes into question. Thank you.
Thank you very much, Christopher. Is there any questions on Division 31? All right, then we will move on to Division 33, the Public Service Employment Act, Division 33.
Thank you very much, Mr. Chair. Before beginning, I'd like to acknowledge that I'm dialing in from the traditional unceded and surrendered territory of the Anishinaabe Algonquin Nation. I'm joined by Michael Moran of the Public Service Commission, which will be a key player in the implementation of these amendments. En octobre dernier, le discours du
Last October, the throne speech announced a plan of action to increase representation of leadership in the public service.
Consultations with employee diversity networks, bargaining agents, and departmental senior officials for employment equity, diversity, and inclusion. Budget 2021 announced the intention to propose amendments to the Public Service Employment Act to reaffirm the importance of a diverse and inclusive workforce and to strengthen provisions to address potential bias and barriers in the staffing process.
The proposed modifications are as follows. First, to add an explicit commitment on the part of the government vis-a-vis the public services regarding inclusivity. The modification would affirm that diversity are not secondary considerations, but they are part of the legislation and the objects of the employment process. Second,
that there would be a requirement that the establishment or review of qualification standards, which are what can set minimum requirements on things such as education, professional certification, and official languages, include an evaluation of bias and barriers, and that reasonable mitigation efforts be made. Third, that the design and the manner of application of assessment methods, which can be things like interviews, written tests, or reference checks, among others, include an evaluation of bias and barriers, and that again, reasonable mitigation efforts be made.
Fourth, see to it that audit authorities of the Public Service Commission, as well as the Commission's inquiry authority, encompass bias and barriers.
For Canadian citizens in staffing processes open to the public to include permanent residents. Currently, the Act gives preference to Canadian citizens in external advertised processes, which can be a very important entry point to the public service. What this means is that if one qualified candidate is a citizen and another is not, the citizen must be appointed. The amendment would expand this preference to include permanent residents. And sixth, the proposed includes a broad definition of equity-seeking group. This means that the provisions of the bill would apply to a broad definition of groups that is based on any of the prohibited grounds of discrimination as outlined in the Canadian Human Rights Act, which include race, national or ethnic origin, color, religion, age, sex, sexual orientation, gender identity or expression, disability, and others.
These modifications, if approved, will be implemented after consultation with employees, bargaining agents, and others to support the overall vision of a more representative public service, representative of the population. It will be my pleasure to answer any questions. Thank you.
Okay, we have Ms. Jansen in the question lineup. Go ahead, Ms. Jansen.
I wonder if you could clarify for me. I understood you to say that a reference check could be a barrier to inclusivity. Are you suggesting then that if someone from a minority would not be able to provide a reference check, that would be a barrier, and so therefore they wouldn't need any longer to provide a reference check?
Thank you very much. I'm happy to help explain that provision of the legislation. So currently, the legislation gives the Public Service Commission, and this power is delegated to deputy ministers and to hiring managers, the authority to use any assessment method that they wish. And that could include an assessment method such as a reference check. Now, there has been both submissions from the equity-seeking groups and from the bargaining agents, and evidence through an audit conducted by the Public Service Commission that different assessment methods can pose bias or barriers to groups in different kinds of ways. And so the requirement in the legislation would be for an evaluation of the mechanism to be done to determine if that does pose bias or barriers, and if a bias or barrier is found, to seek reasonable mitigation efforts. So I can't prejudge right now the conclusion of what that evaluation would find, nor what the reasonable mitigation might be. It could be about the way a tool is used, for example, the type of questions asked. It could be about the degree to which something is used exclusively, so on and so forth. But that would be part of the tool that would be developed to evaluate whether a barrier is in fact, or a bias is in fact posed by that assessment method. And if so, what is reasonable as a mitigation method under the circumstances? That does not necessarily mean that a specific tool might not be used at all. It might mean that there might be suggestions made about how to use that tool to seek to minimize any potential barriers that it includes.
You also mentioned someone's inability to speak French may also constitute a barrier. Is that correct?
I did not speak about languages in the specific amendments. The linguistic requirements under the Act are a separate consideration.
Okay.
Okay, I have Ms. Sirowitz and Ms. Fast. Before I go to Ms. Sirowitz, Ms. Beattie, how many more public servants will it require to do the supervision of the folks doing the hiring within the Public Service of Canada to manage this new system?
So the Public Service Commission will be responsible for implementing these amendments, and they are currently developing their implementation plans. I don't know if Mr. Morin is with us and if he has anything more to add on that point.
Yes, I can add. So we are currently looking at additional resources. These will be to develop new policies, to look at tools to support hiring managers through this process, as well as to conduct audits and investigations related to the changes.
Ms. Surowitz.
Thank you so much, Mr. Chair, and I want to thank you, Ms. Beatty, for the excellent presentation. I'm very supportive around anything that we could do to make our public service more inclusive, more diverse, more reflective of Canada. So and I don't know if you can comment on this, I'm a little surprised that this is a legislative change in terms of us actually having to, review qualification standards. It's odd for me. One would think that would be more of an administrative thing. And I wonder if you could just comment in general about that. That's one. The second comment I have is this is around give permanent residents the same preference as Canadian citizens in external advertised appointment processes. I just need you to explain that one more time. Very open for permanent residents to apply for jobs within the public service. I'm just trying to understand what is the change. I'm not quite sure why I didn't hear it properly. Is it that right now permanent residents are not allowed to apply for a job? Or if they do apply for a job and a Canadian citizen applies for a job and they're both equally qualified, that the Canadian citizen gets the preference? So I just need to understand what the change is there. Thank you.
I'm happy to answer both of those questions. So your first question is about why these changes are being done legislatively. And it is true that many of the mechanisms, but not all of them, could be done through program or policy or other tools. Enshrining the requirement in legislation, of course, brings additional gravitas and enforceability to them for those who will be charged with actually enforcing them. One of the changes that is not possible to do through program or policy is the amendment to the preference. And let me just go back and state that for the things that are possible to do through program or policy, I mean, qualification standards now are currently reviewed for bias or barrier. This is adding an extra layer of having that legislative requirement. In terms of the citizenship preference, there is no official or legislative impediment to permanent residents being hired in the public service. The challenge is the mechanism through which an appointment is actually made. And the legislation does contain a preference for external advertised appointments. So these are positions that would be posted for anyone broadly to apply. So for someone who might already be internal or for a position that is not widely advertised, there is currently no block on a permanent resident being actually appointed to those positions. But for these external advertised positions, the legislation states that there is a preference for Canadian citizens. So that doesn't mean that permanent residents are prevented from applying. It doesn't mean that they're prevented from being considered, but it means that when the hiring manager assesses all of the essential criteria, if they have a permanent resident and a Canadian citizen who meet them equally, who both meet the essential criteria, the Canadian citizen must be hired, given the preference over the permanent resident. And so what the amendment would do would be to add the preference to the permanent resident. And so the Canadian citizen and the permanent resident would then have the equal chance of being hired if they both met the essential criteria. The expectation is that this will reduce a barrier for some who are otherwise qualified to work for the public service. And of course, those external advertised appointments are really a key foot in the door for many people to join the public service.
Thank you.
Okay, Mr. Fast and Mr. Falk, if we could be fairly snappy, we are going to have to go to the next panel and we'll leave the Division 37 to recall them another day. Mr. Fast.
Yeah, well, I'm guessing Mr. Falk is going to ask the same question I was going to ask based on the last comments that came out about Canadian citizens versus permanent residents. I think what you're saying, Ms. Beatty, is that permanent residents, when it comes to hiring, will be elevated to the same level or status as Canadian citizens. Am I correct in understanding that?
They will have the equivalent chance. Yes, that's correct.
And what prompted this?
So the overall goal of the legislation is to seek to reduce bias or barriers to members of equity-seeking groups. There is some evidence that members of visible minorities are screened out of processes at a higher rate due to the permanent resident preference, and so that constitutes a barrier for some members of visible minorities.
Really, like this really floors me. That my Canadian citizenship does not give me priority over permanent resident. I mean, that just blows my mind. And the justification you've just given for that, it doesn't convince me, but I'm open to being convinced. So I challenge you to provide me with a more convincing argument. I did want to get back to a different issue, and that is, you right close to the end of your comments, you listed the different groups that might be discriminated against or may have bias against them. Could you go through that list again for me?
So the list of groups that is going to be protected from discrimination is the grounds that are in the Canadian Human Rights Act, or the grounds which are referred to when in the definition of equity-seeking group. And so that includes it's Section 3, Sub 1 of the Canadian Human Rights Act. That includes race, national or ethnic origin, color, religion, age, sex, sexual orientation, gender identity or expression, marital status, family status, genetic characteristics, disability, etc. And so that is the reference to the Canadian Human Rights Act categories.
Now, you said etc. Are there others that were listed there?
There is one more. I'm just pulling up my thing again, which is not typically one of the grounds that we see, which is conviction for an offense for which a pardon has been granted.
Okay. All right. I think that's all I need to know, but I am concerned about the comment that my Canadian citizenship no longer provides me with priority over those who are not citizens.
Just to remind members, we do have the right to pull any of these witnesses back over the next week, 10 days, if we must. When you sleep in that, Ed, Mr. Falk.
Well, okay. Thank you, Mr. Chair. Mr. Fast is correct that I do want to follow up on comments that he made. And I think I heard Ms. Beattie correctly when she said that this amendment would actually provide preference for a non-residence. And as a response to somebody's question, and I'd like to know too, in what space would we see that an appointment for a position by the Government of Canada should not give preference to a Canadian citizen? That just boggles my mind. So help me understand.
I'm happy to clarify for you, Mr. Falk. So the amendment does not give a preference to a non-resident in any way, shape, or form. The preference that currently exists in the Act applies to some appointments in the public service. Currently, about 45% of appointments are done through this external, non-external advertised mechanism. And it does not prevent a permanent resident from being considered, but it does state that if a Canadian meets the essential qualifications, they are given the preference. The amendment proposes that a permanent resident would be given an equal opportunity to be considered for these processes as the Canadian citizen.
Okay, I'm just reminded of that slogan that the Amex Bank used to have, and that was that membership has privileges. Certainly, I would like to think that citizenship has privileges. And I think that's something that, I don't know if that's direction that you've been given or if it's something that's a suggestion by the department, but this needs serious reconsideration. Thank you, Mr. Chair. Or you can respond. That's fine. Yep.
Go ahead and respond, Ms. Beattie.
So, consideration of the citizenship policy objectives of the government is an important consideration. Some, might express a concern about access to Canadian jobs. But permanent residents having access to public service jobs could result in greater social participation and attachment, and could be a motivation towards citizenship. So, Canada will continue to promote the benefits of citizenship. That is certainly a consideration for parliamentarians in considering your support for the bill. But to be very clear, the intention of the amendment is to ensure that permanent residents and Canadian citizens will be on equal footing when it comes to applying to jobs to join the public service. But in all cases, merit will continue to be the underlying primary principle of the hiring process. I'm afraid, Mr. Easter, I can't hear you. Perhaps you are technically on mute.
Very good reason why you can't hear me, because I forgot to unmute myself. Just on that last point, I'm increasingly concerned about the lack of emphasis that seems to be in the public service these days on the ability to do the job, and the lack of emphasis on experience, life's experience. In terms of people I question who've been interviewed to go into the public service, experience no longer seems to matter, and it should, in my view. So I'd ask you those two questions. How much does experience matter in terms of getting into the public service? And how much does the ability to do the job matter in terms of getting into the public service? I'll tell you what I mean. Within the public service now, you can transfer from Veterans Affairs to agriculture. You get first priority because you're in the public service. But you may not know a damn thing about agriculture. That's part of the problem. So if you could answer that question, and we'll let him move on.
Thank you very much, Mr. Easter. I'm going to invite my colleague, Mr. Morin, from the Public Service Commission to comment on that, given that I'm certainly not an expert in the appointment processes and requirements for them. Mr. Morin, would you care to address Mr. Easter's question?
Yes, thank you for the question. What I could say is it would depend on the nature of the position. Is it a entry-level position? Is it something that requires, depth of experience? So individual hiring managers have to decide on what are the necessary qualifications so that someone is able to meet merit for the job. That can include a range of different experience factors. It can include abilities and skills, and it can include knowledge. But there's no specific formula for deciding which. It really is dependent on the needs of the specific position.
Okay, we'd better move on. I'd better not get into that one. In any event, thank you to our witnesses on Division 33. Thank you both. And we will, my apologies to those that are here on Division 37. I think that might be a little longer discussion as well. So we will leave that one and we will invite you back. So thanks to all the witnesses on this first panel. Thanks, number one, for what you do for the country. We may disagree from time to time, but we really do thank you for your efforts you made during the last couple of years. COVID has really made us all struggle. There's no question about that. So thank you for what you do for Canada. Much appreciated. And that's on behalf of all the members in the committee. With that, we will release this panel, and Mr. Clerk, we will take a 2-minute suspension to give people, if they need to take a washroom break or grab a glass of water, and we'll go to the next panel. So suspend it for 2 minutes. Thank you all. to order. And for those on the new panel, this is meeting number 44 of the Finance Committee. And as you know, we're meeting on Bill C-30, an act to implement certain provisions of the budget tabled in Parliament on April 19th. During this, first of all, my apologies to witnesses for having you sit in the wings for probably an hour a year time. We're 45 minutes of late starting here. We're trying to finish the other panel. In any event, all the witnesses here, I believe, are from the Department of Employment and Social Development, and we'll deal with the Part 4, Divisions 21, 22, 23, 24, 25, 29, 30, 32, 34, 35, and 36. And we'll start with Division 21, which is the Social Security Tribunal. And I would ask you, whoever is speaking on each section, if you could introduce yourself, tell us your position, and whatever colleagues may be here with you to assist you. So on Division 21, who's up? Just yell.
Thank you, Mr.
Ms. Pilat, go ahead.
Yes. Lorraine Pillow, I'm Director General in the Income, Security and Social Development Branch, and I'm here with my colleague, Tara Belanger-Zahab. Division 21 of Part 4 amends Part 5 of the Department of Employment and Social Development Act to make certain reforms to the Social Security Tribunal. The Social Security Tribunal was created in 2012 and became operational in April 2013 as a single window independent tribunal to replace 4 separate administrative tribunals that had made decisions on appeals for benefit claims under the employment insurance and income security programs. When I mention income security programs, that includes the Canada Pension Plan, including Canada Pension Plan Disability, and Old Age Security. In August 2019, the government committed to introduce legislation to reform the Social Security Tribunal and make the appeals process for income security programs more client-centric, streamlined, and faster. The most important legislative amendments are designed to streamline, simplify the recourse processes, introduce a de novo model for second level income security appeals within the SST, where new evidence is allowed with a new and final decision on benefits eligibility, and provide authority to the chair of the SST to make rules of procedure which will govern how the SST functions during the processes. Regulations to follow would be created to include allowing the choice of form of hearing for appellants and authorizing all parties to request that all or part of their hearing be held in private. I will stop there and take questions. Ça me ferait plaisir.
Okay, has anyone got any questions? We'll start with Mr. Fast and then Ms. Jensen.
Thanks so much for that explanation. Could you go back, talk a little bit more about the de novo model? I think what you're saying is that it would allow an appeal to be conducted in a manner that would turn it almost into a new proceeding with either new or maybe additional evidence being presented. Is that right?
Yes, in fact, the de novo model still has a leave to appeal requirement. And so there is a need to show that there's an arguable case based on new evidence to be provided to the appeal division.
Okay. What impact will that have on the timeliness of hearings, the cost to the taxpayer of providing for effectively a second trial, an opportunity for a second trial? Just your assessment. Surely you've done some costing on this.
Yes, so the costs in terms of timeliness, about 80% of the appeals heard before the Social Security Tribunal are related to CPP disability benefits. And And the stakeholders during consultations requested the de novo approach because for many of these appellants, their medical conditions and situations and ability to function evolves over time. And so timeliness for many of these appellants is not necessarily faster. It's actually having the appropriate amount of time to gather any new and evolving evidence, such as new diagnoses, more information about diagnosis or tests.
Okay, before you go on, because my time is short, who are these stakeholders you're talking about?
So a third-party review was conducted by KPMG back in 2016 and 17, followed by a report with recommendations, and then further consultations with stakeholders to reach the options that were put forward.
Okay, and the stakeholders, I want to be drill down. Stakeholders are disability groups?
Disability groups, groups representing seniors and other stakeholders in that appeals process.
So instead of doing a de novo model where you're replicating an earlier proceeding effectively with leave, why wouldn't you simply focus your efforts on making sure that the original hearing is robust, that it protects fully the ability of claimants to make their case?
A couple of points about that. The original tribunals that were combined into the SST had this model where there were two levels of appeal where appellants were allowed to introduce new evidence. And so historically, there was a desire by stakeholders to return to that. But also the general division, the entire process is being made more efficient and more client-centric. So clients will be able to put a good case forward at the general division, but felt that should, again, as their medical case evolves, they should have an ability to bring in new evidence to the appeal division.
Okay, thank you.
Just while you're on client-centric, and I'll come to you, Tamara, how do you see this system being more client-centric? I'll tell you my bias. I believed in the old system. And I've done a lot of pension plan disability cases. And I think if you're talking about in which you did them in your local community in Charlottetown in my case, of which you had one person local, probably two person locals with a person who come in from Ottawa or wherever. And you actually seen the person in the hearing. The person with the disability walked into the room, many of them in tears. And that was where the client could go before the body and make their case. And I assisted many in that. I think that was really client-centric. Now it's more impersonal. It's more paper. It's more computer. So how do you get client-centric out of this new system?
So there are a number of changes that have already been made that are from the SST to make it more client-centric, including the plain language used in communications on the website, the biggest one of which is case navigators, which are employees of the ATSSC and SST, the Administrative Tribunal Support Service, that actually assist clients through the process, answering their questions, letting them know how it goes. The tribunal currently, for the most part, allows a choice of form of hearing for appellants. And we are going to, following this legislation, if passed, we would be introducing a regulation to ensure that the choice of form of hearing remains with appellants, whether it's in person, video conference, teleconference, or on paper.
Thank you for that. Ms. Jensen.
Yes, thank you. You had mentioned, I think you used the term a couple times, that this is going to be more efficient. So I wonder, does that mean that there will be no need for extra employees to make this system work then?
So there is an additional cost, and actually I didn't answer the question about costs. The expected additional cost would be 11 million in fiscal year 2021-22 and 10.6 million ongoing. since much of this is related to an anticipated increase in number of cases at the appeal division. Much of that funding, some 90% of it, would come out of the Canada Pension Plan fund because it's related to Canada Pension Plan cases, and about $1 million per year related to old age security appeals.
So I failed to understand. You're going to be more efficient, but you're doubling the amount of cases. I failed to understand how that's more efficient.
So the current system has a very legalistic approach to allowing people to access the appeal division, and it's one that many appellants and stakeholders criticized for being extremely legalistic, requiring representatives to have legal support, etc. It's based on error of law, etc. Having the appeal division open up to de novo cases reduces that legalistic barrier and yet allows evolving evidence to be placed in front of the hearing. So it's more client-centric from that perspective. A number of the other changes that have been made, for example, the Social Security Tribunal has regularly reduced its delivery standard or number of days to get through hearings. So there have been a number of other ways in which the tribunal has become more efficient.
Are you saying that they won't require a lawyer?
They may choose a representative of their choice, but in fact, the legalistic nature of getting in the door for an appeal division hearing will be much reduced.
Okay, I see no further questions from members. Thank you, Ms. Pilot. And we will now turn to Part 4, Division 22, which is the Canada Labour Code Equal Remuneration Protection. Who's up on this one? Ms. Laurie? I see somebody bending forward there. Go ahead, who's ever on.
Thank you, Mr. Chair. My name is Barbara Moran, and I'm the Director General for Strategic Policy Analysis and Workplace Information at the Labour Program at ESDC. And I'm joined today by Laurie Struznicki, who's an Executive Director with the Labour Program. So I'm here to discuss amendments that are being proposed in Part 1 of the Canada Labour Code. Part 1 of the code governs industrial relations and establishes the framework for collective bargaining between unions and employers in the federally regulated private sector. Part 1 applies to industries such as air transportation, interprovincial and international transportation, banking, telecommunications, and broadcasting. Amendments are proposed to better protect employees in the air transportation sector affected by contract retendering at airports. Many employees in the air transportation sector have continued to work through the pandemic, deep cleaning aircraft, safely handling baggage, and performing other critical services that have allowed essential air travel to continue. These employees are at risk when a service contract changes hands between contractors. This practice, known as contract retendering, can result in employees being paid less when they are laid off and rehired, even if they're retired to do the same work. There's currently an equal remuneration protection in Section 47.3 of Part 1 of the Code that ensures that after a case of contract retendering, the new contractor cannot remunerate pre-board security screeners at a rate lower than that provided by the previous contractor under the terms of a collective agreement. The equal remuneration protection currently only applies to employers covered by Part 1 of the Code that provide by way of a contract for services with another employer. The proposed amendments will extend equal remuneration protection to all federally regulated employees covered by a collective agreement in the air transportation sector working at airports. This will ensure that when a service contract changes hands, affected employees are not paid less than employees of the previous contractor who provided the same or substantially similar services. I'm happy to take any questions.
Thank you very much. Barbara, is there any questions? I see none. There was fairly good discussion at this on the evening briefing. So I believe you're off the hook, Barbara. We'll turn then. Thank you very much. We'll turn to Division 23, which is the Canada Labour Code federal minimum wage. Mr. Charter, are you on?
I am on. Good morning. Okay. Good afternoon, that is. Thank you, Mr. Chair. Good evening, everyone. My name is David Charter, and I'm the Director of the Research and Innovation Division at the Labour Program at Employment and Social Development Canada. I'm here today with Sébastien Saint-Arnaud, the Manager of Policy Development at the Labour Program. We're here to talk about the proposed amendments to Part 3 of the Canada Labour Code in Division 23 of the Budget Implementation Act related to minimum wage. Part 3 of the Canada Labour Code establishes minimum working conditions such as hours of work, annual vacations, various types of job protected leaves, as well as setting the minimum wage for employees in the federally regulated private sectors. The federally regulated private sector includes about 6% of all Canadian employees employed in industries such as banking, telecommunications, interprovincial and international transportation, certain activities, most federal crown corporations, and certain activities on First Nation reserves. Part 3 does not apply to the federal public service. Currently, Part 3 of the code sets the federal minimum wage as the general minimum wage established by the province or territory in which the employee is usually employed. The mandate letter of the Minister of Labour includes a commitment to raise the federal minimum wage to at least $15 per hour. Budget 2021 announced this legislation that amends Part 3 of the code to establish a federal minimum wage of $15 per hour that would rise with inflation and with provisions to ensure that where provincial or territorial minimum wages are higher, that wage will prevail. The new minimum wage would come into force 6 months after royal assent. And to ensure that the federal minimum wage remains relevant and rises with inflation, on April 1st of each year, after the year the amended minimum wage provisions come into force, the minimum wage would be adjusted based on Canada's Consumer Price Index for the previous calendar year. I'll finish off my remarks by mentioning that our estimates are that approximately 26,200 employees in the federally regulated private sector earn less than $15 per hour and will benefit from the new minimum wage rate. Thanks. Happy to take any questions you might have.
Thank you very much, Mr. Charter. Going to Mr. Julian.
Thank you very much. Now, is there any provisions for making the rise in the minimum wage quicker than the 6 months after royal assent?
No. Right now in the legislation, the $15 minimum wage would come into force 6 months after royal assent, and then it would be adjusted in April of the year after the year the provisions come into force.
Okay. Thank you for that. And just a brief comment, Mr. Chair, if you'll permit me, that was in the NDP's election platform for the last 2 elections. So good to see it there.
I'll not mention what other parties it was in. Ms. Jensen.
Yes, I was wondering first if I could get a list again of who are you saying this is applying to? Which jobs? I know you're saying private, federally regulated private companies, but what was the list you gave us?
Sure. What I can say is Part 3 of the Canada Labour Code applies to federally regulated companies, and that includes industries such as banking, telecommunication, interprovincial and international transport, federal crown corporations. But I could also just add that I mentioned that 26,200 employees making less than $15 per hour would likely be impacted by this change. And they work in industries like road transportation, non-road transportation, postal and courier, banking, telecom, and broadcasting.
And then my next question is you're suggesting that this minimum wage is tacked right closely onto the inflation rate. What if inflation rates become exorbitant over the next little while under the impact of COVID?
As you mentioned, the new minimum wage will be indexed based on the CPI. in April, the year after these provisions come into force. There is a provision in the amendments whereby if the CPI goes down, there would be no adjustment. So the minimum wage couldn't go down, but there is no provision in these amendments related to exorbitant inflation.
So if we would have, say, throw a number out there, 10% inflation, then the wages would go up that much and they would never come back down from that.
At the moment, the way the legislation is drafted, there's no provision to not have an adjustment were inflation to be high.
Okay, thank you, Ms. Jensen. To Mr. Falk, followed by Ms. Zerowitz. You're muted, Ted.
Yeah, I knew that would bite me eventually. Thank you, Mr. Chair. Just a question. Your team has obviously done a SWOT analysis on this program. And have you got any numbers at all as to how many of those 26,000 jobs would no longer exist if this happens?
I can answer that question for you if you'll bear with me. It is possible that there could be some disemployment effects related to putting in place a federal minimum wage, which would be a negative impact on either employment or on hours work, especially potentially for those who are lower skilled or who have less experience, maybe for young people. But there's growing international research that suggests that that disemployment effects such as these are not as high as previously thought. Depending on assumptions, looking at different elasticity rates that my team looked at, our estimates are that it could be a range anywhere from, say, 162 maybe to 800 jobs that could be impacted by disemployment effects, where there might be a reduction in hours or other impacts on employment as a result of this.
Okay, thank you. You've probably also heard the adage that a rising tide floats all boats. And if we're going to increase the bottom end of the wage structure, everything else will increase proportionately. And so at the end of the day, there won't be a net benefit because costs are going to rise. Inflation, this is actually going to fuel inflation. And what is your study on that shown you as a result?
I think what you're asking about is spillover effects from this minimum wage. And it is true that it is possible that there could be some spillover effects like wage adjustments for employees who are making 15 or slightly above 15, and employers might do this in order to retain or attract employees. What I'd say is the size of the spillover effect or that impact is somewhat uncertain, and it's kind of difficult to estimate. But what I could say is it's not likely to impact anyone making more than about $2 over 15 or $2 over that minimum wage rate.
Okay, thank you for those answers.
Okay, Ms. Zerowitz, last question in this panel.
Thank you, Mr. Chair, and I want to thank the Mr. Charter for his presentation. Thank you. I have 4 tiny questions for you. They're so small, I'm sure you'll be able to respond very quickly. You had mentioned that there's 26,200 federally regulated employees that would benefit. How many in total do we actually have? So how big is the bucket, if you could start off with that? The second question I have is, actually, why don't I just hear that and then I'll ask you subsequently my small question.
Certainly. I'm just scrolling down to my list, and it's roughly about 919,900 employees.
So you said 918,000, more or less?
919 and 900. So just about 920.
Perfect. Okay, thank you. In terms of the cost of living increase, in terms of, I think the question that Ms. Jansen had said, that if inflation, hopefully this never gets there, gets to 10%, and the way that legislation's written, the increase would go to 10%. How is it different than our, as members of parliament, we actually get an automatic cost of living adjustment every year as well. Is it written differently? Is it the same?
The way it's written in the amendments is that the minimum wage will be set at $15 per hour. Mm-hmm. And then on April 1st, the year after these provisions come into force, the minimum wage will be adjusted, and it'll be based on the increase in the Statistics Canada's Consumer Price Index for that year, whatever percentage that increase was for the previous year. That'll be the rate at which the minimum wage is adjusted upwards.
And do you know if that's the same as how it's written in for members of parliament in our annual increases?
I'm afraid I'm not aware of how the increases for members of parliament are calculated.
Okay, thank you. What do you think the impact would be? Often there's a line, at least I use this, that the impact is, and I don't know if it's true, so I want to ask you, so keep me honest here, that like I actually sort of agree with this $15 minimum wage, which to Mr. Julian's earlier comment was a promise in our Liberal platform, and I'm glad that the NDP has followed us along. But what do you think the impact could be on other provinces who might not have a minimum wage of $50, like of a minimum wage below $15?
So what I can say to that is that, of course, these changes will put in place a federal minimum wage. So they're amending Part 3 of the Canada Labour Code, which applies just to the federally regulated private sectors, and the provinces and territories will continue to set their own minimum wage rates. And so I can't speak to whether the provinces or territories might choose to raise their rate or not. But what I can tell you is that right now the rates in the provinces are between $11.45 and $16 per hour, and that this federal rate will be equal to or on par with all jurisdictions, with the exception of Nunavut, whose rate is set at $16 per hour. But as I mentioned in my remarks, these provisions include a provision whereby if the provincial or territorial rate is higher, that rate will prevail. And there's also a trend in provinces and territories to automatically adjust their minimum wage rates based on indexing formula. So quite a number of provinces and territories already regularly increase their minimum wage rates based on either the provincial or the federal consumer price index.
So it could have an influence then.
Well, I mean, like I said, I can't speak to whether provinces and territories will choose to make a change, but this rate is amongst the higher ones in provinces and territories. But many provinces and territories already have systems in place to regularly increase their minimum wage rates.
Thank you.
Okay, I'll go to Ms. Jansen, followed by Mr. Julian.
Yes, I'm just wondering if you looked at the impact this will have on small business. So, for instance, like the local restaurant. I mean, obviously, if you're saying, okay, if you're federally regulated, you must get minimum wage. You must have looked at how much that will impact those that are not federally regulated.
Well, I in my last response, I just spoke to how it might have an impact in the provinces and territories, who are those who are not federally regulated. But I think I heard you saying how it might impact small business. And right. So what I can tell you about that is, of the 26,200 employees who will benefit from this change, roughly 4,000 work in in businesses that employ 20 or fewer people, so fairly small businesses. And another 4,400 work in businesses that employ 20 to 99 employees, so still fairly small. And then 3,500 work in businesses that employ 100 to 500 employees. But the majority work in large businesses that employ 500 or more employees, to the tune of 14,200 of them, which is 54% of the employees that will benefit. So there will be a cost. While there will be an impact in terms of impacted employees, the bulk are in the larger employers, and the same profile applies when it comes to costs. But I can say that the total cost that we expect for employers to pay these additional wages to bring these 26,200 employees up to $15 is expected to be about 44.1 million for the first year, which is 0.1% of annual federally regulated private sector payroll.
Oh, I was actually talking about those outside federally regulated, but I mean, extra cost after a pandemic is a huge issue. And so I'm just wondering if you looked at outside of the federally regulated sector, because obviously if federally regulated is changing their minimum wage, that will impact those that are not federally regulated. Small business, mom and pop shops.
So, you know, when in terms of extra cost in COVID, I mean, like I mentioned, there will be costs for federally regulated private sector employers, and one thing that was also considered was the fact that across provinces and territories, like I mentioned, a lot of provinces and territories already have processes in place to increase their minimum wages. And during the pandemic, they have continued to index and update and increase their minimum wages as time passes. As far as looking at
I'm kind of wondering dollar figure, like how much, you know, you mentioned that you figured out the dollar figure for those who are federally regulated, how much they're going to be impacted dollar wise. But I mean, outside of that, obviously small business is going to be impacted by these changes. So, I mean, it's one thing to say, well, it's only going to cost this much, but it actually, like you have the spillover effect, it's going to cost much more.
Right. And so I do have a cost figure for federally regulated small, medium, and large businesses like I just described. And like I mentioned, it is possible that there will be spillover in the federally regulated private sector for employees making $15 or up to potentially $17 per hour. I don't have a costing figure for employers in provincially regulated sectors.
Okay, Mr. Julian.
Well, first, quick clarification, Mr. Chair. Ms. Zurwitz said that the NDP was following the Liberals. And of course, you'll recall, Mr. Chair, that in 2015, the Liberals mocked the NDP for raising the $15 an hour minimum wage. So it's very clearly the evidence and the receipts are on the table.
Is this a question on Division 23?
No. Yes, absolutely. So there's two aspects. There's the aspect of the increase in the minimum wage, but also the economic stimulus that comes from that. You've got people who are actually earning a more adequate salary. They're spending more in the community. So I'm wondering to what extent the department has actually analyzed both the benefits in terms of community positive economic ramifications of raising the minimum wage, and of course, as well, the increase in tax revenues that come with people earning a higher wage as well.
Thank you very much for your questions. Both good questions. I'm afraid I don't have data or figures on hand for the impact to GDP or the economy or the additional tax revenues, but as I mentioned, what we're looking at is about 26,200 employees in the federally regulated private sector. So the economic benefit would be commensurate to the amount of employees impacted.
Okay, then that will end the discussion on Division 23. Thank you very much for your presentation and answering our questions. We'll go to Division 24, which is the Canada Labour Code, leave related to the death or disappearance of a child. Who's up on that?
It's me again. So Barbara Moran from the Labour Program. Welcome back,
Barbara. Good to see you.
Thanks very much. And I'm joined by Sebastian St. Arnaud, who was with you on the last session as well. So I'm going to briefly discuss the changes that are being proposed to the leave related to death or disappearance of a child under Part 3 of the Canada Labour Code. In September 2018, the Government of Canada replaced the Federal Income Support for Parents of Murdered or Missing Children grant program with the Canadian Benefit for Parents of Young Victims of Crime. This was done in response to a 2017 report by the Federal Ombudsman for Victims of Crime, which recommended broadening eligibility for the program in order to mitigate barriers to uptake. The new benefit includes a number of changes to make the income support more inclusive and flexible, including extending the age limit of the victim from under 18 to under 25, expanding eligibility to parents whose children under the age of 14 are a probable party to the crime, increasing the income support amount by $100 to $450 per week, doubling the period in which recipients can receive the benefit to 104 weeks in situations where the child disappeared, and allowing recipients to work up to 20 hours a week while receiving the benefit. While the new benefit was introduced in 2018, the government did not have the opportunity to make corresponding changes to the leave related to death or disappearance under Part 3 of the Canada Labour Code. So what's proposed here are amendments to Part 3 of the Canada Labour Code that would align the leave related to death or disappearance of a child with the improved Canadian benefit for parents of young victims of crime in order to provide employees in the federally regulated private sector with job protection while they receive the benefit. So what these changes include are extending eligibility for the leave to parents of children from under 18 to under 25 years of age. And this change recognizes the changing characteristics of Canadian families that sees adult children staying with their parents beyond the age of 18, increasing the maximum length of the leave from 52 to 104 weeks in instances where the employee is a parent to a child that has disappeared. With this change, eligible parents whose child has disappeared would be entitled to the same amount of leave as parents whose child has died. Increasing the total amount of leave that may be taken by employees in respect to the disappearance of a child from 52 to 104 weeks, and this allows 2 or more parents of the same child who has disappeared to share up to 104 weeks of leave. And this amendment reflects the change that extends the maximum duration of leave for parents of children who have disappeared from 52 to 104 weeks. And finally, for parents of children under the age of 14, eliminating the exception that disentitles employees to the leave if the child was a party to the crime that led to their death. I'm happy to take your questions.
You're muted, Mr. Easter.
Already. Thank you very much. I said, Barbara, thank you very much to you and Sebastian for making your points. We'll turn now to Division 25, which is payment to Quebec.
Thank you, Mr. Chair. My name is Benoit Cadieux. I'm the Director for Employment Insurance Special Benefits at ESDC. I'm joined today by Catherine Demers, Director General of EI Policy at ESDC. In response to the COVID-19 pandemic, the Government of Canada has introduced temporary measures that increase the generosity of the EI program and make it easier to access EI benefits, including maternity and parental benefits. These measures include a minimum weekly benefit rate of $500 and a reduced eligibility requirement of 120 hours of work to qualify for benefits. Expecting parents in Quebec are covered by the Quebec Parental Insurance Plan, or QPIP for short. This replaces EI maternity and parental benefits in that province. Without corresponding changes to align QPIP with EI, some parents in Quebec could have been in a situation where they could have qualified for maternity or parental benefits under EI, but not under QPIP. Or they could have received a higher benefit rate under EI than they would have under QPIP. Provisions under Division 25 authorize the Minister of Employment and Social Development to make a one-time payment to Quebec for the purpose of offsetting some of the costs of aligning the Quebec Parental Insurance Plan with the temporary measures set out in Part 8.5 of the Employment Insurance Act, ensuring that parents in Quebec receive the same level of support as parents in the rest of Canada. The Minister is also authorized to enter into an agreement with Quebec to set out the time and the manner of the payment. Thank you. And with that, I'm happy to take any questions.
Is there any questions? I see none. Then we will go to, no questions. Thank you very much, Mr. Cadieux. We will, just to give members a heads up, we are going to have to adjourn at 5:30 Ottawa time, or right around there. There's 3 members have notified me that they have other commitments, so we will have to stop at the appointed hour. So we'll go to Division 29, which is the Department of Employment and Social Development Act.
Good afternoon.
Welcome.
Hi, Mr. Chair. It's Frances McCormick. I'm an Executive Director with the Labor Program at Employment and Social Development, and I'm joined today by Charles-Philippe Rochon, a Senior Advisor in the Labor Program. Today we're here to talk to you about Division 29, an amendment to the Department of Employment and Social Development Act to authorize the Minister of Labor to collect and use a person's social insurance number to verify their identity in the administration and enforcement of the Act, DESDA, any program activity for which the minister is responsible. The purpose of the amendment is to support the modernization of services to Canadians delivered by the Labor Program, with a particular focus on improving the digital capacity. So this now includes implementing new systems that we're currently working on that allow federally regulated employers and employees to file reports and complaints of a protected and electronic nature. The submission of these files has to occur behind a protected environment. As an example, my Service Canada account, which uses the social insurance number as a mandatory identifier to register and use the platform. The SIN would also be used, for example, to identify correctly employees who are entitled to unpaid wages or particular benefits. Finally, this measure would shift us from current paper-based processes, which can be time-consuming, to a more robust system based on modern technology. Although the amendment will come into force upon royal assent, the Labor Program will develop protocols and update and create privacy impact assessments to ensure the privacy of these individuals is safe and secure, and that the collection and use of SIN under any new authority. Conditions and safeguards on the use of the personal information are found in the Employment and Social Development Act, as well as the Privacy Act. Thank you, and I'm happy to take any questions.
Thank you very much, Ms. McCormick. Is there any questions from members on Division 29? Pretty straightforward. Okay, thank you. We will start into Division 30, student loans and apprentice loans. Mr. Raymond?
Thank you, Mr. Chair. I will make it very short. I'm the Assistant Deputy Minister of Learning Branch in Employment and Social Development Canada. Division 30 proposes to waive interest accrual on Canada student loans and Canada apprentice loans for 2 years between April 1, 2021 and March 31, 2023. No interest will accrue during this period, ensuring that borrowers facing financial impacts of the COVID-19 pandemic can better manage their student debt as the economy recovers. Thank you, Mr. Chair. I would be happy to take questions.
All right, is there any questions on Division 30, student loans and apprentice loans? Seeing none, thank you very much, Ms. Raymond. Mr. Raymond, let's go to Division 32. Which is increased old age security pension and payment.
Thank you, Mr. Chair. I'm Kristen Underwood. I'm the Director General in the Income and Social Security Development Branch at ESDC, and I'm here with my colleague Kevin Wagden, who's a Director in the Income and Social Security Development Branch. So just quickly, the government is proposing to increase the OAS pension by 10% for seniors age 75 years and older. As seniors get older, they tend to have lower incomes and often face higher health-related expenses because of the onset of illness or disability. And this vulnerability is further compounded by a reduced ability to supplement income with paid work, by the risk of outliving savings, and the risk of becoming a widow or widower as people age. With this measure, the government is addressing the financial vulnerability that seniors face as they age.
It will take place in 2 parts, subject to parliamentary approval. The first part will be a taxable one-time payment of $500 in August 2021 to meet the immediate needs of OAS pensioners who are 75 years or older as of June 2022. And secondly, a 10% permanent increase will be made to the monthly OAS pension for seniors aged 75 and older beginning in July 2022. This change will strengthen the financial security of 3.3 million seniors, 56% of whom are women, and changes to the Old Age Security Act will be made to exempt the one-time payment from the definition of income for the guaranteed income supplement. Thank you, Mr. Chair. I'm happy to take questions.
Okay, I have 2 questions in the lineup, Mr. Julian and Mr. Fast. Mr. Julian.
Did the department do any sort of legal analysis around the discrimination against those who are on CPP and OAS who are under 75? I mean, there's been understandably a lot of outrage around not the increase, but the increase only applying to those over 75. So to what extent did the department do an evaluation around potential legal challenges around that discrimination, leaving those 65 to 75 out and providing supports that are necessary? There's no doubt there needs to be an increase, but from 75 and over.
Ms. Underwood or Ms. Wagner? Mr. Wagner?
Sure. Thank you, Mr. Chair. I think that the change is focused on those 75 years and older because of the risks as people get older. I've talked about the lower income they often face, higher health related expenses, and the onset of illness and disability. So these risks are there, and people are at greater risk as they get older, and that's why the benefit is focused at those 75 years and older.
Yes, but that doesn't actually, thank you for that, doesn't actually answer my question. My question is, was there any legal analysis done?
Kevin, do you want to take that?
Yes, I can say that legal analyses are done as part of all the proposals that are put forward. But our focus was on the policy rationale, as Kristen mentioned, the idea that there was a policy evidence to suggest that folks who are 75 years and older, they were experiencing different financial circumstances than those who were 65 to 74.
Okay, will you share that legal analysis with us?
Go ahead, Ms. Underwood.
Mr. Chair, I don't think it's normal practice to share legal analysis from internal.
That's normally the policy, but go ahead, Julian.
Well, no, I think the committee members would like to have that information, so you can see some nodding heads as well. So we're requesting it. Thank you.
Okay, is there only one more question on this? Ms. Underwood, on that question, you'll have to if you could get back to us on what you can provide, that'd be helpful. I'll take Mr. Fast, and then we are going to have to close. If there are other questions, we'll have to bring the witnesses back. Mr. Fast?
Yes, Ms. Underwood, you said those over age 75 are experiencing different challenges than those under 75. I'm assuming you've done a full analysis of that you could share with us?
Sure. Thank you, Mr. Chair. Yes, so we did do some analysis looking at levels of employment of seniors who are over 75 compared to those under 75. A number of other
levels of employment.
Sorry.
Levels of employment for those over 75 versus under 75?
Yes. So levels of employment, percentage with disability, percentage of severe disabilities, numbers who were women, numbers who were widowed, percentage of pensioners with lower incomes, with OAS with lower income. So we can provide that.
Could you provide us with that analysis?
Yep, sure, we can provide that.
Do it through the chair. And my last question is, who made the actual decision to cut it off at 75 I mean, it could have been 76, could have been 64. Somebody made a decision. Was it someone in the civil service? Was it someone within the political family? Who made that decision?
I don't think that's a question that the public service can answer.
With respect, Mr. Chair, if in fact it was someone in the public service, she could answer that question.
If it was, but if I recall correctly, it was in the platform of the governing party.
So it was a political decision that was made, and then it was backed up afterwards by analyses. So putting the cart before the horse, is that what happened?
Never seen that happen in politics. You got anything to add, Ms. Underwood, or your colleague, Ms. Wagner? Okay. Is there any further questions on this division? There is information, Ms. Underwood. You can provide us certain information, and you're going to look into the legal aspect to see what you can or can't provide. All right. With that, we are over. Is this an absolutely necessary question, Ms. Jensen? I got to let a couple of people go. You okay? All right. Then we will. We still have divisions 34, 35, and 36. We'll have to invite those witnesses back. We'll have to find time to do that somehow over the next week. With that, look, thank you to all who presented today, provided your evidence and answered a question. And with that, we will have to adjourn because I know some members are already late for other commitments. Thank you. Meeting adjourned.